Financial markets are incredible discounting machines, and they're discounting the future story, and that's really about this tariff story.
If these tariffs stay, all bets off, because it changes the whole paradigm.
There is a hope trade, though, in the market. I think the hope is that this is the start of negotiation and that this is actually not going to stick.
Tariffs are going to be high, and I think they're going to be high for a while.
The hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Should we get your week started? Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, and the White House isn't backing down.
Because of the tariffs, we have $7 trillion already committed to be invested in the United States. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
The president sticking with the game plan. Baseline tariffs are active, and additional tariffs kick in just a few days' time.
There is no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade. The countries of the world are ripping this off, and it's got to end. The president has made it crystal clear. This is the policy we are going to protect. The factories that come build in America, we are going to protect them. They're going to be successful.
That's sending the S&P 500 towards a bear market and fueling fears about an economic downturn. The Treasury Secretary rejecting the idea that we're heading for recession.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
This administration has had its say. This week, it's corporate America's turn to have its voice. Doubter results are out on Wednesday. Big banks are dropping on Friday. Earnings season is just around the corner.
How do they give guidance at a time where there is none? This is going to be a pivotal couple of days before we get that potential guidance from companies. To me, really, the quote of the morning comes from Deutsche Bank's Jim Reed and David Fokerts-Lando over at Deutsche Bank. At the moment, there are few signs that this administration are backing down. Where are the off-ramps? Rarely, if ever, have the next few days been so important, John.
We spent the weekend debating one question. Is this the beginning of a negotiation, or are these the new rules of the game? I think after the weekend, we're starting to lean away from the former and much more towards the latter.
If these are the new rules of the game, what does that mean for global trade? What does that mean for the U.S. economy? What does that mean for the global economy? Lower. That seems to be the message from markets. You can say whatever you want, that markets have it wrong, that markets are influenced by globalists. You could say whatever you want, but right now, the unabating message from global markets worldwide is that this is going to suppress growth and potentially on the margins increase inflation, but it's less an inflation story than it is really something more of a recession.
Where does it leave the bond market? 2-year, 10-year, 30-year. So a bit into twos. Yields down to the front end, 8 basis points on 10s. People running around screaming recession, and your 10-year bond yield is lower this morning by just 3 basis points.
That's exactly the point that I think is the right one. This has been a real question as we do face a fiscal cliff in the United States. How much of a haven can long-term bonds be? Let's say there is a recession, and here comes the fiscal question. How much room does the United States have to borrow to support an economy at a time with a fiscal deficit at a record high? And this is the tension that you feel in the 10-year that's keeping it from going even lower.
Equities recovering just a touch. We're still lower by 2.8% on the S&P 500 this morning. Coming up this hour, Chris Verrone of Strategas as the sell-off deepens, Ed Mills of Raymond James as some countries push to negotiate, and Justin Wolfers of the University of Michigan as Secretary Bessent dismisses recession concerns. We begin this hour with stocks falling following their biggest two-day drop since March 2020 as President Donald Trump defends his tariff plans. Annmarie was on Air Force One with the president over the weekend. AMH, he remains defiant.
He remains defiant when it comes to his tariff plan, Jonathan. I think one of the key messages the president said to us reporters last night was, I'm willing to make a deal with China, but they have to solve this surplus. He then also talked about the European Union, this idea that the United States no longer wants to have trade deficits bilaterally when it comes to trading partners. And for me, that feels like that is a new line in the sand, and whether or not this question of this is a negotiation or no rules of the game. I asked the president that specifically. He didn't want to answer that question. One question he was willing to answer was whether or not there was this idea of what Trump put. Is there a threshold that this administration is willing to tolerate and be willing to maybe to try to talk up the market, talk about having deals done, maybe not have these tariffs enacted on these high rates? And the president said, of course, he doesn't want to see anything go down, but he called it necessary medicine. He said he was elected on this. So that's where this White House is left today. There's reports in Japan that potentially we can have a call this evening in Japan, in the morning in Washington, D.C. with the Japanese prime minister. The president told us over the weekend he heard from a number of leaders, European, Asian leaders. He spoke to 4 or 5 tech CEOs, but he remains defiant in what he is doing in terms of the tariffs, and those tariffs look to go into effect.
Annmarie, thank you. Much more from Annmarie throughout this morning, live from Washington, D.C. Mentioned Japan, the Nikkei closing down by close to 8 percentage points lower. In Europe, the DAX at the moment, Lisa, down by close to 5.
Given the fact that when the U.S. sneezes, the rest of the world catches a cold, you are seeing a ripple effect around the world. Initially, there was a feeling that maybe the U.S. would be the epicenter. What we're seeing in markets right now, not necessarily the case.
Let's extend the conversation. Chris Verrone of Strategas, a bad company, writing the following. The S&P's trend is likely to turn negative. It empirically changes how we think about the market's character and raises the bar for what's necessary out of any rally. Chris joins us now for more. Chris, good morning.
Good morning, John.
Where do you want to begin? I think we start with the bond market.
Yeah.
Where's the rally on a 10-year? Where is it?
Well, it's funny. We started the year by writing, be careful what you wish for. We thought yields would go lower, but we were worried about why. And I think now we've certainly learned why yields are down. I think, Lisa, you make a great point about this idea. Why is the long end not lower? I think the long end's complicated here. I think the short end is very, very straightforward. The 2-year yield is screaming. I think it's screaming at the Fed. I think it's screaming at global central banks that they need to wake up here. The 2-year yield's 350, 345 this morning. You're, call it approaching 100 basis points below where the effective Fed funds rate is. That was enough in September to get the Fed to go with the S&P at an all-time high, with gold at an all-time high, with spreads at record tights. If that was enough then, it should certainly be enough now.
The 2-year might be screaming. Yeah. And certainly there are people who are even pricing in an emergency rate cut akin to what we saw in 2020. But I want to sit on the long end for a second. Is that screaming, too, that this isn't going to be the same kind of buffer at a time where that fiscal overhang is a serious problem? Where is the fiscal response to any kind of downturn, given the deficit? Yeah, well, I think the fiscal response is unlikely to come here. I think you have a much greater chance that the fiscal response comes from either Europe or from China here. So the bond markets in that part of the world, I think, do look different. When you think about this dynamic between 2s and 10s, the message everywhere you look globally is curve steepeners. So you have fresh highs in 210s in Germany, fresh highs in 210s in Australia, fresh highs in 210s in UK, and here, I think the message of curve steepeners remains the most dominant trend in the market. And what's that mean? I mean, in terms of going forward, the ability for nations to finance themselves, and what this means for risk
slower
assets.
Growth.
Okay, right.
I think it's certainly slower growth. I think the short end in particular, when you look at 2-year yield, we always say in our work, who needs Fed speakers when you have the 2-year yield? And the 2-year yield, I think, has been doing all the speaking that's necessary for what the Fed should be doing here. You go back again to September, a 50 basis point cut against pretty benign conditions. And fast forward to today, it seems when you listen to Powell speak on Friday, he was a little bit too calm for the backdrop.
So whenever you have a moment like this one, you ask, where is the leverage? And if you think about the last 5 years, the leverage has switched to the sovereign balance sheet, which I think raises the question again about what's happening with 10-year treasuries here. No, I'm not going to sit here and say that in the next downturn, the bond market is going to sell off. That's not my call. I'm going to ask you if that's going to happen. In this downturn that we're about to experience, we go into it with budget deficits around 6%. We had budget deficits around 6%, even with unemployment at 4%. Yeah. What do people think is going to happen to the deficit if we go into a deep economic downturn?
Well, it's funny. It's not that budget deficits at that level in a recession would be that much of an eye-opening statement. It's the fact that we ran that in a relatively benign period of economic growth over the last several years. I think that's the concern. I would argue that's what gold has been suggestive of for so many years. in a way, maybe gold should be our scorecard here. I do find it interesting gold has reversed lower over the last couple days. I think that's a reflection of two things. Number one, for the last 2 or 3 years, gold's strength was sovereign buying, it was central bank hoarding. Over the last 4 or 5 weeks, that has changed. You have seen a surge of retail flows into GLD. I think that's likely reflective of the broader sentiment environment. But gold reflecting or gold reversing lower here also suggests this indiscriminate selling phase of the drawdown, right? What do we look for in these corrective, panicky moments? We look for indiscriminate selling, sell what you can. We look for capitulative price action. I think we're getting closer on that front. And we look for sentiment extremes. I think certainly you're seeing more of that over the last 72 hours.
And then we look for the policymaker to step in. You mentioned Chairman Powell. Absolutely no sign of that going into the weekend.
None. And I was going back over the weekend, going through all of our historical comps. Certainly 87. 1962, I think, is an interesting comp here as well. Even the Reagan drawdown in 81, I thought was notable. The 87 move was really arrested that Tuesday morning when there was a statement from Greenspan just saying, hey, we're available. We're watching what's going on. I think we're still a far away from that when you look at what Powell said on Friday.
Does a Powell put have the same power that a Trump put would? I mean, it seems like this is asymmetric right now, given that Jerome Powell is dealing with an issue that is not created nor solved by a central bank.
Yeah, it's a good question, and we've kind of framed it as, is the strike price on a Powell put or a Trump put higher? I think we're going to learn here this week. Now, remember, we're down with the open today. We'll be down about 20% on the S&P, give or take. I think that does price in a lot of the immediate moment. Whether that prices in a recession down the line, that's to be seen. But down 20 in a matter of a few weeks does price in a lot. We are seeing, Lisa, what I would describe as, maybe not 08 capitulative action, but certainly kind of in the zip code of 2020, certainly in the zip code of 2011, certainly in the zip code of, say, 1998 LTCM.
So are you buying?
I think when you look at these moves, we describe it as a bang and a whimper. I think we're in the bang phase of this drawdown right now. High drama, high emotional. 85% of the time, these lows are retested somewhere between 4 weeks and 4 months down the line. We did a lot of work on this over the weekend. I want to buy the whimper. I think the whimper follows in the next number of months.
Hey, Chris, it's good to catch up.
Good to catch up with you.
Sir.
Thank you.
Chris Verrone there of Strategas, a bad company. The next Federal Reserve meeting, May 6th, May 7th. Bob Michael of JP Morgan Asset Management with us yesterday evening. Lisa making the case that the Fed might not make it to the next meeting.
And there are plenty of people who agree with him. Remember, that's what happened on May 3rd and then on March 15th of 2020 for the Federal Reserve. What would have to break, though, for that to happen?
Equity markets at the moment, and they're not blinking. Still, equity futures at the moment down by 2.4% on the S&P, slowly recovering and well off session lows. With an update on stories elsewhere this morning, let's cross over to Danny Berger for your Bloomberg Brief. Hey, Danny.
Hey, John. Hedge fund billionaires Bill Ackman and Stanley Druckenmiller have come out against President Donald Trump's decision to launch global tariffs. Ackman called the tariffs a mistake and said a 90-day pause is needed to resolve the U.S.'s historically unfair global trading position. In China, policymakers have discussed measures to stabilize the economy and markets in the face of President Trump's tariffs. Sources telling us that the measures will focus on boosting consumer spending, birth rate, and subsidies for some exports. They may also include a stabilization fund to support the equity market. Speaking of this equity market, longtime Tesla bull Dan Ives has soured on the stock. In a Sunday note, Ives slashes 12-month price target on Tesla by 43%. He wrote, Tesla has essentially become a political symbol globally, and that is a very bad thing for the future of this disruptive tech stalwart and brand crisis tornado that has now turned into an F5 tornado. And that's your brief. John.
Hey, Danny, thank you. The bulls are still bullish. Let's be very clear about that. John Stolfus of Oppenheimer came out over the weekend and cut its price target from 7,100 down to what? 59.50. 59.50 based on the close of Friday. We're talking about 15% upside. The bulls are still bullish. They've just repriced a whole lot lower.
At the same time, late last week, he came out and defended 7,100. he came out and said that he could still see almost 30% upside and talked about how this would blow over and there would be some sort of capitulation. How much credence can you give into the new price target?
I think they still need to capitulate, don't you, based on some of that?
Exactly. That's the point. This is the reason why we've seen consecutive cuts to people's outlooks in the matter of weeks.
Equity futures on the S&P recovering somewhat, still lower by 2.6%. Up next, negotiate or retaliate.
The fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation.
Up next on the programme, Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures lower here, recovering somewhat though. We're down by 2.4% on the S&P. On the Nasdaq, we're down by 2.5%. Jamie Dimon at JP Morgan just releasing his annual shareholder letter. Lisa, while inflation has come down, most of what I see in the future is inflation rate.
Yeah, he said the recent tariffs will likely increase inflation and are causing many to consider a great probability of recession. He called for a quick resolution, saying the quicker this issue is resolved, the better, because some of the negative effects increase cumulatively over time and would be hard to reverse the first time he has commented on the tariff policy.
Trade tariffs and trade policy at the epicenter of uncertainty. Under surveillance this morning, negotiate or retaliate.
The fact is the countries are angry and retaliating. And, by the way, coming to the table, I got a report from the USTR last night that more than 50 countries have reached out to the president to begin a negotiation. But they're doing that because they understand that they bear a lot of the tariff. And so I don't think that you're going to see a big effect on the consumer in the U.S. because I do think that the reason why we have a persistent long-run trade deficit is these people have very inelastic supply.
So here's the latest this morning. President Trump's economic team standing firm behind their sweeping tariff plan. European Union trade ministers meeting to outline a response. Let's head over to Luxembourg, where Ollie Crook is standing by. Ollie, welcome to the programme. Let's look at this market in Europe. It's not being spared. Equities in Europe are getting absolutely hammered. How are the Europeans planning to respond?
What I think is very interesting, John, is before going into any of these meetings, before sort of setting out what their negotiating position, the trade ministers who just started to convene here in Luxembourg, what they're really trying to do is trying to reassure the European market, the European economies, that things are going to be okay and not to panic. Going into this meeting, you start to see kind of the nuances of what the conversation is and the different views that exist within Europe. And of course, one of the great disadvantages that the Europeans have here is they don't have just one person making these decisions. They need to come to consensus. We had actually a nice moment here where you had at the one time the German economy minister speaking and the Irish deputy prime minister speaking. These are the two countries that basically make up the lion's share of the deficit with the United States. The Germans basically saying we need to be very aggressive here. We do need to negotiate. We do need to talk, but we need to put all of the tools on the table, including the anti-coercion tool. While the Irish were saying that is basically the nuclear option, and the single thing we need to do now is de-escalate. All of the Europeans would like to see a negotiated solution. Whether or not that is possible is a separate question. I mean, listening to Donald Trump over the last couple of days and the rest of the cabinet, I'm not sure that this is an administration that is ready to negotiate right now. It is possible also that the Europeans want to take a little bit more time, let the markets do some of the work to try to soften the conversation. But right now, this is the conversation that is happening with the ministers right behind me.
Well, the heat's on both sides. Ollie, appreciate the coverage as always. Check out the equity benchmark in Frankfurt, Germany. The DAX lower by more than 4 full percentage points. Annmarie standing by in Washington. Annmarie, any sign that this president over the weekend, any glimmer of hope for the Europeans that he is willing to sit down and negotiate?
Not yet. I really gathered from this gaggle yesterday with the president on Air Force One that this pain he is willing to tolerate to get to better deals. And I believe the red line seems to be trade deficits. He went on really about China when it comes to the trade deficit. He said, I'm willing to make a deal, but they have to fix the surplus. And Jonathan, when it comes to the European, it was very similar. And to get a bit more perspective on exactly where we could see this policy going, I'm excited to say I'm joined by Ed Mills this morning of Raymond James. Ed, thank you so much for joining. A big question we have going into this week is this a negotiating tactic? There's reports in Japan the prime minister will get on the phone with the president this morning, D.C. time. Or are these the new rules of engagement?
I think it's a bit of both. And I think that they need more revenue to go to the tax cuts. I do think that this is a big part of trying to change policy, Annmarie. But I think that the problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They look at the meeting between Trudeau, Zelensky. They don't want to be embarrassed. They also don't know what the president actually wants. He says he doesn't want a trade deficit, but there's some of these countries that will never be able to be at par. You look at Vietnam in particular. I think one of the saving graces potentially is that the only thing that is still not subject to tariffs are USMCA compliant goods. That was a deal that he struck in his first term. Is he trying to send the signal that if I negotiate a deal, that I am willing to stick with it? The more USMCA goods are excluded, the more he can lean into that argument.
But trade deals take years to hammer out. Is the damage going to be done?
That's the question for markets. And when I talk to folks at Raymond James is that they are concerned that what they thought they understood about President Trump is not what they're getting, that there is a big concern that the equity markets are no longer a barometer of his success, that they are concerned that he is going to be pushing for a change to the world global order that has existed since the end of World War II, and that they are concerned that he might go too far because his advisors are telling them in his first term, he didn't go fast enough, and that he wasn't able to do the change in the 4 years that he was president, and that there is a desire to go stronger, hold the course, and try to push for additional change that we were not pricing into this market.
Will there be legal or congressional challenges to the tariff plans?
I think that there's going to be both. I think with Congress has the ability under the National Emergencies Act to undo this emergency. However, it requires a veto-proof majority. We saw the Senate pass a resolution on the Canada tariffs last week. That was only 51-48. It was a majority, but not veto-proof. If he's not cutting deals, the tensions will grow. When you look to the courts, he used emergency powers.
AIPA.
Yeah, AIPA. Back in 1971, Richard Nixon did the same thing, used emergency powers to put a worldwide global tariff as we came off the gold standard. There was a strong argument there about an unbalance of payments. Then in 1974, Congress passed a trade act that said if there is an uneven balance of payments, the president's authority is to use what's known as Section 122, where you can put a tariff on for 150 days up to 15%, 1.5. This is not what the president did here. So did the president violate the congressional intent? Did the president use emergency authority when there isn't the subcontext for an emergency authority? The problem for me is that the courts almost exclusively never say that the president's emergency action was not legitimate and that the beef might be with Congress, that the Congress has to make their action under the National Emergencies Act to turn off the emergency.
Staying in Congress, some good news for the administration was the fact that the Senate passed this budget. It's going to go to the House this week. When do you think we will see the extension of tax cuts?
So I'm always looking for a crisis or deadline in D.C. before we act. You look at Republicans, and they're trying to do this with the debt limit. So to me, that goes right up to the August recess, so probably the June-July time period. And when you look at that bill, what passed in the Senate was at least $5 trillion worth of tax cuts over the next decade, a $300 billion increase in defense and immigration spending. That would be the single largest bill in the history of the United States. And a lot of people look at this and say, all right, well, this is not going to be stimulative because it's a continuation of current policy. But when you add in the changes to no tax on tips, overtime, Social Security, extension of SALT, extension of the child tax credit, in the business tax credits, I can come up with a reasonable argument that over the next year or two, that's somewhere between $500 billion and $1 trillion of additional stimulus. That's where the market is going to say that's the bull case from here, especially if we start getting some of these trade deals struck.
Ed Mills, thank you so much from Raymond James. Jonathan, though, tariffs in focus, and he says it's a bit of both, negotiation and maybe new rules of the road.
Annmarie, thank you. Just to keep a tally of where the equity market is, at the lows we were down by 5%. Right now in the S&P, some of that weakness is being bought. We're negative by around 2.3% on the S&P 500. One note to watch a little bit later on this morning, 10:30 Eastern Time, you will hear from Governor Kugler of the Federal Reserve, the first scheduled Fed speaker, responding to the price action of the past few days and the headlines over the weekend.
Will she be as defiant, maybe, as what we heard from Fed Chair Jay Powell, who said the emphasis very much clearly is on inflation, not tackling some sort of impending downturn?
The Federal Reserve isn't blinking. Up next on the program, Aneesha Sherman of Bernstein on the impact of tariffs on retailers. From New York City, You're watching Bloomberg TV. Two-day slide on the S&P, down 10.5% in just 2 sessions. Thursday, Friday, moves we haven't seen since the pandemic. This morning, kicking off things Monday, we're down by 2.5. Overnight, down as much as 5. On the Nasdaq 100, entering a bear market into the weekend, we're down another 2.6% this morning. In the bond market, 2-year, 10-year, 30-year, front end of the curve, very straightforward. Pricing in some big moves from the Federal Reserve. Will we get it? That remains an open question. Yields down by 7 basis points. We're lower for an 8th consecutive session. Over that period, down by more than 40 basis points. The 10-year, far more interesting. Why isn't the 10-year maturity rallying? Yields, Lisa, 3.99.
You've raised this question. At what point is the risk, the credit risk in sovereigns, particularly the United States, where the deficit is so steep? There are a lot of questions as to why it's not rallying more. What it is clear to show is that the easy trade is the short end. Longer term, people are too confused to even make some sort of decisive call.
In this phase of the sell-off, it's always confusing because it could be a matter of sell what you can and not what you want. So these kind of moves can be misleading at times, but I think those questions around how bonds will respond in the next economic downturn deserve to be asked.
Especially because it's coming in tandem globally. It is not just U.S. Treasuries, and it's coming as there is a re-leveraging of the fiscal balance sheets of everyone other than the United States. So at what point does the U.S. yield curve become susceptible to trends elsewhere rather than the other way around?
Let's turn to crude just briefly. Brent and WTI. Brent crude is lower again. WTI as well. WTI crude is down about 16% in just 3 sessions. And yesterday, as soon as we started trading, Lisa, a break of 60.
Yeah, this is a really strange story. On one hand, this is the fact that an increasing number of Wall Street firms have projected recession as their base case, including JP Morgan with a 60% chance of contraction. On the other hand, there was a price cut by Saudi Arabia at the same time that there was an output increase. This is an interesting story, although it is reflected by commodities more widespread.
Crude down by 3%. Equity futures recovered just a touch. We're lower by 2.6%. Let's get to your morning movers this morning. Let's cross over to Danny Berger with more. Hey, Danny.
John, there's no shortage of stocks underpaying this morning to choose from. Breadth is horrible. Only 10 stocks on the S&P 500 are higher in the pre-market session thus far. Banks under pressure. Goldman Sachs, the worst of the large bulge bracket banks, down more than 3.5%. Adding insult to injury, Morgan Stanley downgrading Goldman, saying that this is the bad kind of market volatility. It is one that is bad for investment banking and for money management fees. So those shares under pressure. Much like the banks, we're also seeing the private market players under pressure too. IPOs being paused, M&A frozen, Apollo down 4.33%. What does that also mean for the task of rebuilding America and the investment that some of these might be willing to put in? Now, lastly, rounding up with one of the worst stocks on the S&P 500 in the pre-market session. This is an interesting one. Off the back of a Reuters report, Howmet Aerospace is declaring a force majeure, meaning that they do not have to honor their contracts because of an unforeseen event. They supply a lot of crucial parts to plane makers, both commercially and military uses. Those shares down some 7%, underscoring some of the supply chain ripples we might yet see to come, John.
Danny, thank you. More from Danny later on this hour. On our radar this morning, President Donald Trump defending his tariff plans and dismissing recession fears. Trump also saying he wouldn't strike deals to cut the highest tariffs unless they eliminate the U.S. trade deficit with that country.
Which creates a real issue for people who are looking at this as a tactic to negotiate deals rather than a goal in and of itself. Because ultimately, how do you get no trade deficit with a country like Vietnam that doesn't have the capacity to buy as much from the U.S. as vice versa? It goes to the heart of what are the off-ramps to de-escalate this. And right now, people are having a hard time finding any, especially as we get responses around the world.
To make it simple, going into the weekend, we sat here on Friday morning and we said, who blinks first? Chairman Powell. He didn't blink. Over the weekend, they dug in.
Yeah, and not just that. What I thought was most interesting was the TikTok deal. It was supposed to get done over the weekend. It didn't. It got pushed 75 days. Otherwise, it would have been banned in the United States. And there was a Bloomberg report talking about how China hardened its stance after the announcement of tariffs on April 2nd, that they had been taking a really subdued approach and that they shifted because they were personally insulted and felt like we cannot negotiate with this person. So how do you take this and de-escalate it when it already has taken on a life of its own?
I don't think anyone was surprised by the TikTok news. We sat here on Friday and we all said, Who are they negotiating with? Maybe there was a deal. A deal with who? Because it certainly didn't involve the Chinese going into the weekend.
If you want to take a silver lining, and last night I was looking for silver linings.
You find one?
Maybe it was that it was postponed and it wasn't just, killed outright. And there wasn't the sense that it was banned. But you're right. It's not a huge surprise. That said, reporting said that there was a deal in place, but China decided to withdraw at the last minute.
Let's sit on China. Policymakers discussing accelerating plans to unleash stimulus in response to President Trump's tariffs. Sources telling us here at Bloomberg the measures will focus on boosting consumer spending, the birth rate, and subsidies for some exports. So they've got a number of options with regards to the tariffs. They can retaliate. They've said they would. They could capitulate. They might. They could turn around and say we're going to devalue the currency, or they could lean on fiscal. That's the list on a menu right now. What do they pick?
And how about all of the above? And that seems like maybe there's going to be a little bit of all of the above, except maybe not negotiating as quickly as they are going to pull these other levers. The fiscal measures that have been proposed are interesting in how much they differ from the past ones. They have to do with boosting consumer spending, the birth rates, as well as subsidies for some exports. At what point is this the counter response that will give people confidence to go elsewhere and actually have an attractive investment proposition? That said, the Chinese market's down, 13% right now?
The Hang Seng down 13%, the CSI 300 down 7%. Ugly session. It missed the gap lower on Friday, but certainly they're in the crosshairs as well.
And so it seems like to the extent that there is some sort of stimulus, there is some sort of response, market traders are not saying that they're going to be immune from this pain.
Let's get to the bulls on the south side. Tesla and the big bull, Dan Ives of Wedbush, cutting his price target on the stock by 43%, saying the company has become a political symbol, writing, quote, "It is time for Musk to step up, read the room, and be a leader in this time of uncertainty." That name is down again this morning by around 4%.
Yeah, and we have heard on the margins that Elon Musk is going to step away from the administration. A key question now is how much influence does he have over policy? Elon Musk told Deputy Prime Minister Matteo Salvini both Europe and the U.S. should move, ideally, in my view, to a zero-tariff situation, effectively creating a free trade zone between Europe and North America. And then Peter Navarro, in an interview on Fox News, came out and said that that is simply a tech mogul who doesn't understand the complexities of trade and that he sells cars and should stick to it.
Some tension between the two.
Very clearly.
I noticed the same thing. I wonder who wins out. I think that Elon Musk was tweeting as well this morning, posting rather on X, mentioning an argument against tariffs, which is a timely one to post, that's for sure.
How does he stack up at a time when his own people are telling him, hey, these are going to hurt us, and his stock is tanking?
That's the latest on Tesla. The latest on the equity market, continuing to recover, still lower by 2 full percentage points this morning. Let's turn to retail. Shares of US sportswear companies tumbling in the pre-market. Aneesha Sherman of Bernstein writing, a US recession stagflation scenario will hurt all discretionary goods names. Big brands would face higher risk of slowing consumer demand, while fast-growing brands with a compelling product and right to gain share in the US are more protected, at least initially. Aneesha joins us now for more. Aneesha, welcome to the programme. I just want to understand from your perspective what these retailers and some of these sportswear brands do on day one. Are they putting prices up immediately? Are they pausing production? What are these companies doing?
Well, you have to remember that some of the inventory that they have on hand is not subject to tariffs. Whatever's already in the United States, whatever's already en route to the United States, on ships, on containers right now, is not subject to tariffs. So they do get a little bit of a reprieve for at least the current quarter and perhaps some of the subsequent quarter from inventory that's already en route. So the first initial move that we have heard from the industry is they are trying to get as much onboard vessels as possible before April 10th. So just to get the tariff-exempt product on board. The second move is likely going to be pricing, but I don't think we will see a sticker shock of pricing across the board. I think it will be more new product that is introduced will be introduced slightly higher price points. Nobody wants to be the price leader here as demand is starting to slow down. And so companies are going to be very hesitant on pricing. The other thing they're doing behind the scenes is they are renegotiating up and down the value chain to try to share some of this pain. That means renegotiating with their vendors, which are in some of these countries in Southeast Asia, as well as renegotiating with their customers, which are the big retailers, the sporting goods retailers that sell their product. They did this 2 years ago when freight costs went up. They shared the pain up and down the value chain. They're going to be doing this again.
What I hear is a lot of absorption of potential cost from these tariffs. What I don't hear from you is the idea of moving production back to the United States. Is that on the table for any of these retailers?
I don't think that is a realistic scenario. From a timing perspective alone, it would take at least 1.5 years to set that up. From a cost perspective, it is not feasible given where labor costs are, given where supply chains are. It's unlikely to do. And especially for specialty apparel and footwear, where you have particular shoe molds, particular styles, particular capex that some of these suppliers need to invest in order to produce, for example, a performance running shoe. You're talking about years of investment before you can get something like that up and running, not to mention the cost of it. So I don't think that is a realistic scenario that brands are considering.
Aneesha, you mentioned the demand aspect, which is the harder thing to gauge, especially at a time where right now, at least in backward-looking data, the consumer is fairly strong. I just wonder, at what point does it become cost prohibitive to pass along any price increases whatsoever, given the fact that a lot of people in the soft data are already expressing concern about their jobs, concern about their costs, and concern about the economy?
Absolutely. And this is where, you showed my comments up on the screen earlier. I mean, this is where I think it really depends on which brand you're talking about. If you are a big incumbent brand that is already facing a slowdown in demand, many of the brands and retailers in this first quarter commented on that. They already saw a slowdown in their traffic trends. They're seeing sentiment come down. It's going to be harder for them to pass on a price increase. However, smaller brands that have a compelling product that is selling through at full price and have kind of the right to gain share in the U.S. have a little bit more of an edge here, especially when they are premium priced and appealing to a more higher income consumer that is not going to be the first one hit from massive inflation in the U.S. So there's some difference here where I think fast growing, premium priced, premium and luxury, smaller brands will be able to pass on some price increase, whereas the big incumbents will struggle to do so.
So, Aneesha, as some people wake up this morning and look to pick up some of the pieces, the equity market recovers just a touch. It's down by 1.7% on the S&P. What are your top picks? What are those names that you and the team are looking for?
Yeah, so into this downturn, I think we would look for names that have a compelling product or brand, that have pricing power, that have a higher income consumer, so less exposure to low income consumer, and that have demonstrated pricing power and the ability to pass on some of that price. And those names in my coverage, I like TJX. They are going to be a recession winner. They're going to be a trade down winner. They've done AUR increases for the last 4 years, and they can pass on in a discrete way some price increases. I like Tapestry. That is a affordable luxury Coach brand, which is a trending brand at the moment. They've done price increases for the last several years. They could easily pass on the bulk or most or all of this tariff increase. And I like On, which is a small footwear brand, which has low market share, a premium product, again, pricing power in the U.S., and a strong sell-through that shows no indication of slowing down so far.
Aneesha, great to get your thoughts. Appreciate your time. Busy week coming up for us all. Aneesha Sherman there of Bernstein on some of the retailers. Lisa, I'm pleased you brought up the factory question. It's such an important one. We talked about this repeatedly with regards to Vietnam. Wage differentials are so large. The prospect that these factories are going to move, even with tariffs north of 40%, the prospects are still pretty low for some of these industries.
Which is by design. I mean, how do you end up recreating not just the factories and building them out, but also the ecosystem, people trained to manufacture some of these things? That's why people are looking at Apple in particular, and whether they will increase the cost of their iPhones, given the fact that they have to either pass along the tariffs or find different production than mainland China.
Equity futures recovered just a touch, with negative hit by 1.7% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. JP Morgan Chase CEO Jamie Dimon is urging a quick resolution to what he called tariff policy issues. In his annual shareholder letter, Dimon wrote, "The quicker the issue is resolved, the better. Some of the negative effects increase cumulatively over time and would be hard to reverse." Dimon predicted an increase in inflation for both imported and domestic goods. Meanwhile, billions of dollars worth of IPOs are on hold as President Trump's trade war upends the global economy. Sources telling Bloomberg that ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend deep losses. Israel's Prime Minister Benjamin Netanyahu will meet with President Donald Trump in Washington in order to seek a better tariff deal. The two will also discuss the war in Gaza, the situation in Syria, and the Iranian nuclear program. Netanyahu will be the first world leader to meet Trump since he announced tariffs on more than 60 countries. And that's your brief. John.
Danny, thank you. A news conference a little bit later on that front. That's going to be must watch. Equities then recover a touch. We're down by 1.5% on the S&P. Up next, the White House remains defiant.
I see no reason that we have to price in a recession. I reject that assumption. There doesn't have to be a recession. Who knows how the market is going to react in a day, in a week.
That's one view. Here's another one. Justin Wolfers of the University of Michigan joins us next. Live from New York, you're watching Bloomberg TV. Equities off the lows, down 5% overnight, now down by 1.7 on the S&P 500. Lots more cuts to price targets across the street, including from Evercore. Julian Emmanuel down to 5,600 from 6,800. Oppenheimer of John Stolfus down to 5,950 from 7,100. That's a big adjustment from him. What once sounded bearish, though, is now sounding bullish. Targets, Lisa, like 5,950, 5,600 from where we are. People would take that right now, they'd rip your arm off.
Especially given that some of the downside projections are for 4,200 in the case of a recession, that according to Lori Calvasina. Morgan Stanley's Michael Wilson is saying that maybe the S&P could sink another 7 to 8% if these tariffs remain in place.
If you're just joining us, welcome to the program. Under surveillance this morning, the White House remains defiant.
I see no reason that we have to price in a recession. I reject that. The assumption there doesn't have to be a recession. Who knows how the market is going to react in a day, in a week. What we are looking at is building the long-term economic fundamentals for prosperity that I think the previous administration had put us on a course toward financial calamity.
So here's the latest this morning. U.S. Treasury Secretary Scott Bessent rejecting the idea that these tariffs will cause a recession. Justin Wolfers of the University of Michigan writing, these tariffs are going to hurt a lot. They're going to reshape your life in much more fundamental ways. I'm pleased to say that Justin has given us some time this morning. Justin, good morning to you, sir. Let's just breathe some life into that quote. When you say this is going to change people's lives in fundamental ways, what do you mean?
Mate, next time you walk through the supermarket, just pick up that box of cookies or that pasta or that avocado and just look on the side for where it's made. Even when it says whether it's made in America, think about where the raw ingredients came from. And very quickly you'll discover that every part of our lives is profoundly integrated with the global economy. And what we now have is, on average, 20% tax on every interaction we have with the rest of the world. So we're going to have to shift what we buy, we shift how much we can afford, the rest of the world's off doing business with each other. This is a shock very much on Americans.
Justin, you said small tariffs create small problems and big tariffs create huge ones. How much of this is just simply price increases? How much is this a real crimping in the economy? And how much is this actual supply chain disruptions akin to what we saw during the pandemic?
Yeah, so, Lisa, this is one of the few networks where I can actually come on and talk about it this way. There's something I hope your viewers remember from when they took introductory economics, which is that the cost of a tariff rises in the square of the tariff. So, when we move from 1% to 2% tariffs, which is basically what we did under the first Trump administration, it's just not a big deal. If a 2% tariff can lead you to switch off buying something, you probably didn't want it that much anyway. But now we're moving all the way up to 20% tariffs. And so by my calculation, that means that the second set of the tariffs in the second Trump administration will literally be 50 times more painful. To put it in simpler language, in the first Trump administration, if things became a little bit more expensive, you could sort of soldier on and a percentage point here and there you're not really going to notice. Here, every time you go to purchase something, every part of your supply chain, every store you visit, you want to ask yourself a question before you walk in. Hey, do these prices make sense? Can I afford to keep doing this? Ought I be looking at a substitute, even if it's a substitute I don't like as much? And that's the sense in which this is really fundamentally going to change every part of our lives.
Which raises the question of what the bigger risk is right now. Is it stagflation or is it recession? And people have been asking this question. Initially, stagflation was the main case. If this really does suppress demand, at what point are we just talking outright recession?
Listen, I think one of the hard things to do right now is to interpret the news that we're getting. So realise that stocks have fallen 12, 13% over the past few trading days. But realise they'd already priced in their best guess at what the Trump tariffs would look like. And even right now, they're pricing in a very large probability that Trump backs off. So if you took all of that out, that suggests that markets believe that the cost of these tariffs are much, much larger than the 12 or 13% that markets have subtracted as a result. So if they got clarity that Trump were going to stick with this, it would be even more calamitous. Look, you raise a really important question, which is it's a very, very asymmetric set of risks. And so here's the thing Trump doesn't understand, which is he remembers from when he was young that there were there were large trading barriers with a number of countries. That's simply not true. We had decades and decades of trade liberalisation, and it's no longer true. So, look, heads we win. We can get a country like Vietnam to get rid of its tariffs. But realise the gain there is Vietnam's going to reduce its tariff rate from 1.1% to 0. Tails we lose, we're facing 34% tariffs on trying to export stuff from China. So this is a game where there's not much to win, but there's a whole heck of a lot to lose.
Justin, can we sit on the sources of inflation and the potential for further price increases? When you look across the economy at various industries, and you mentioned food production repeatedly through this conversation, are there certain industries where demand will be high, but capacity will continue to be low and constrained here domestically in the United States that you would worry about in the coming months?
Mate, I'm just going to tell you I'm not very good getting down to the sector-by-sector stuff, so you've got all sorts of really smart analysts, and so I reckon you ought to pose it to them.
I'm sure I'll ask them that question, and they would probably point to what you've pointed to, food production, and that could be the issue going forward from here. That raises the question about consumer price tolerance, Justin, and maybe you can speak to that. This is going to be the interesting interplay for us as we watch financial markets and how corporations respond in the coming days. The interplay between margins, whether they'll absorb some of this or whether they'll pass it on, consumer price tolerance. Are we in a different phase of the economic cycle compared to where we were several years ago when consumers could absorb some of the higher costs?
Mate, we're in a very different place. So, first of all, during the last downturn, we had enormous amounts of government support coming. And more to the point, we had, through 2021, a government that, whether you like it or not, appeared to be competent on its face. We had no surge in economic uncertainty. Look, one of the things that's really unnerved all of us over the past few days is not just the tariffs. It's the clown show that's come with it. It's tariffs on penguins. It's setting tariffs proportional to the bilateral trade deficit, which no economist on earth will tell you is defensible. And then it's sending out the entire cabinet to the Sunday shows where each one of them on a different network gave a different rationale for what's going on, basically leaving us all with the conclusion that the global economy is being held hostage by the whims of just one man, which is not usually how we like democracies or economies to work.
Justin, I appreciate your time, sir, as always, and your honest response, as always. Justin Wolfers there at the University of Michigan. The president offering his honest view of things. He says oil prices are down, interest rates are down, the slow-moving Fed should cut rates, food prices are down. Lisa, there is no inflation.
Yeah, and then saying the long-time abused USA is bringing in billions of dollars a week from the abusing countries on tariffs that are already in place. This is doubling down on the message that he already has put out there, which is this isn't a problem, wealth will return, and that right now there is no reason to back away.
Just to reiterate, the president is not blinking. And equity futures roll over just a touch. We're down by 2.3% on the S&P. Up next, Dan Skelly of Morgan Stanley, Henrietta Treyz of Veda Partners, Kamakshya Trivedi of Goldman Sachs, and the former senior Trump trade advisor, Kellyanne Shaw from New York City, the second hour of Bloomberg Surveillance. Up next.
I would look at this as a shock to the economy.
It doesn't seem like we're going to get relief quickly.
This is a serious moment. I do not think the Fed can just sit on the side.
All of this could change with one headline, for the better or the worse.
Once the snowball starts going downhill, you can't stop it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Nobody's blinking. Chairman Powell into the weekend did not blink. The administration over the weekend dug in. Equity futures this morning negative by 2.2% on the S&P 500, down as much as 5 overnight. The losses continue. On the Nasdaq, we're down by 2.4. On the Russell, we're down by 3. In the bond market, 2-year, 10-year, 30-year. For an 8th consecutive session, the 2-year yield is lower, down by more than 40 basis points over that period. On a 10-year, though, you're not getting much comfort here. We'll debate this through the hour. We're only down by 2 basis points on 10s. We're up 2 on 30s. Your week ahead looks like this. Retaliation on the cards. Reciprocal tariffs kick in just 2 days' time. A day later, China is set to retaliate. The same morning, we get US CPI. Then later in the week, bank earnings. Corporate America gets its say and where it thinks this economy's going.
And what it's doing ahead of that, because it doesn't afford to be able to just sit tight and watch it happen. Corporate executives need to make decisions. They need to figure out who they're going to hire, where they're going to cut back, and how they address some of these tariffs. Look, there is a real question here about when people can start to get more optimistic. I think everybody is looking for some silver linings, a sense of breathing after a couple of really carnivorous days. At this point, though, even though Max Kettner of HSBC says that we have now entered thoroughly oversold conditions, people are trying to buy this, and they just can't get the confidence to quite do that.
Where's the circuit breaker? Bob Michael of JP Morgan Asset Management joined us for some special programming yesterday evening and made the argument the Federal Reserve won't make it to the next meeting. The next meeting concludes on May 7th. He believes they might have to move before then.
What would trigger them to move at a time when Jay Powell came out and said that he is squarely focused on inflation and it is a different time now than back in 2018 because of the inflation we're coming off of? It would take a break in the system. That is what happened back in March of 2020 when Treasury started to sell off because it was a sell what you can, not what you want moment. Is there that kind of reckoning on the table that the Federal Reserve would have to respond to? And barring that, will they really move given that the backward-looking data still is really solid?
So pull up the bond board again. Let's go through it. 2-year, 10-year, 30-year. Just focus on the long end. Front end's really simple. Federal Reserve rate cuts, growth declines, all of that. Further out along the curve, it gets more interesting. 30-year yields are higher by 2 basis points. 10s are barely moving. 397 against the backdrop of an equity market that plummeted overnight.
This is fascinating, and you're right to pick this up. What is this suggesting? Is it people boycotting the United States and longer-term treasuries? Is it them not acting as much as a haven? Is it people selling what they can, not what they want? Or is it that we are in a new paradigm where globally, ex-U.S., everyone else is raising money for fiscal stimulus, and the United States might have to do the same, and even if they don't, the fiscal overhang from the deficit is significant enough to raise some concerns about how much confidence people can have to go into the long end.
A lot to work through this morning. Equity futures on the S&P down by around 2 percentage points. Coming up this hour, we'll catch up with Dan Skelly of Morgan Stanley as the market rout continues. Kamakshya Trivedi of Goldman Sachs on why he sees the yen as a top hedge, and the former senior Trump trade advisor Kellyanne Shaw as the president tells markets to take their medicine. We begin this hour with US stocks lower following the biggest 2-day plunge since 2020. Dan Skelly of Morgan Stanley staying cautious and writing the following. The tariff announcement has materially changed the outlook, which has created real technical and fundamental pressures for the market. While this remains a fluid situation, it will take time to resolve. Dan joins us now for more. Dan, good morning.
Good morning, John.
What phase of the sell-off do you think we're in right now? How would you describe this moment?
John, it feels early still. It's volatile. We've seen a lot of deleveraging by the hedge fund community, so we're down to low 40s now on net leverage. You typically don't see a capitulation bottom till a 3 handle is in that number. We still haven't seen retail really selling dramatically. If anything, retail was buying last week in size. So we think we're still early on, John, and as you mentioned, 48 hours to go until the deadline.
It's kind of amazing to see one of the biggest policy shocks, in the words of many economists, that we've seen in the last century, and yet GDP forecasts have been downgraded something like 1 percentage point. Can you reconcile those two things?
We still don't have really clarity in terms of whether or not we're going to collect, what tariffs are really for, whether or not we're going to collect on tariffs, whether or not there's going to be negotiations, and whether or not the consumer, which has been dominated by the high end for 2.5 years, is really going to be affected as much as the low end. So we truly don't have clarity just yet.
What do you think is going to lead on the way up, given that Magnificent Seven has been the hardest hit since their highs over the past couple of months?
We got to remember, Lisa, that Magnificent Seven is something like 55% of profits coming from overseas. So while they have a lot of secular AI-driven growth, they also tend to have a lot of international-driven growth. So we don't really see Mag 7 coming back to the fore if these tariffs stick. We see actually more domestically oriented industries, financials, healthcare, software and media being some of the more preferred industries to look at, particularly given the ongoing uncertainty of tariffs.
How concerned are you? We started this conversation, we started the hour, John mentioning the 10-year and the 30-year yield, and how it wasn't responding the way that it has traditionally with a hard rally of people buying as a haven. What's the signal you get from that?
It's an excellent question and observation. And look, our folks are expecting inflation to accelerate, actually, closer towards high threes, 4% this year. So I think it has to do with the fact, in terms of the tariffs being passed on, in terms of a tax, and whether or not that will ultimately lead to higher inflation. And so we've been trying to think about, how do you ultimately diversify? If stocks are in a sell-off, if bonds aren't being the ballast that one would assume, we've been thinking more and more about themes, frankly, that we've been talking about for some time, related to real assets, related to privates. Frankly, this is not a bad time for investors to start rethinking their public market exposure and maybe some opportunity to hide out in illiquid-oriented privates.
Does that include their international equity exposure? Because that is where a lot of people sought diversification in 2025. Overnight, the Nikkei down by almost 8%. Lisa mentioned the Hang Seng down by 13. The DAX at the moment, as we speak, is down around 4. What do you do with those longs that people piled on at the start of the year?
John, you referenced at the outset this ability of reaction function for international, and I would just highlight that we do see rising signs, whether it be China or Europe in particular. They do have the ability to do fiscal stimulus and to generate some type of domestic demand function. So we would say to folks, don't abandon some of that international diversification just yet. Keep in mind there was a long holiday, so people are now just catching up to some of the news from last week in the U.S.
Well, I just want to go back to this point that you're making about public markets not being a haven in any capacity, even in developed market debt, and that private markets offer some sort of offset. Are you saying that you could see public market, developed market debt not act as a ballast, and it wouldn't ripple through to the rest of the economy in a pretty profound way?
It could in the near term. I mean, it's an excellent question. What we're just saying for our wealth clients who tend to take longer term oriented investments and who have been candidly underallocated to privates for many years, that the disruption going on right now in the public world may be a time just to sit out for some time and think about their broader goals and broader plans to get exposure to some more idiosyncratic performance via private market horizon over a longer term time frame.
How much, just when you talk about the international exposure, how much when you talk about inflation is that a global phenomenon? And does it stem not only from trade barriers, but the likelihood that we're going to get some sort of fiscal impetus from Germany, from China, from elsewhere in Europe?
I mean, I think when you look at some of those other markets, inflation has been elevated, but it certainly hasn't been maybe as pronounced as in the U.S. I think China has been exporting deflation for many years now. And I think the reality is that they've been holding their cards pretty close in terms of stimulus, but they have signaled overnight they're willing to do more rate cuts, willing to do more fiscal to stimulate domestic demand. So they're clearly saying that they have room to go and they're not as concerned about inflation.
We've had the China shock once, started 25 years ago. Huge disinflationary forces gripping the global economy. Is the rest of the world about to get a second China shock? If the walls go up in the United States, are we about to get another disinflationary bust worldwide?
I think it certainly could be, John. I think the question is, how long do the walls stay up? And I think the reality...
You've got your doubts. It's the second time you've gone there. Where do these doubts come from?
Well, I think the reality is that we ultimately saw tariffs as a risk, but we saw them more as negotiating tactics. And so we're not necessarily sure that you don't have some détente in terms of particularly some of the East Asian countries who have incredibly dominated export growth. And so whether it be via currency changes and devaluations or maybe coming to the table on some of the current tariff levels, I think there's still some hope that things may change in the next several weeks.
I'm smiling because I find it amazing. Here we are, 2 days out from reciprocal tariffs kicking in, 20% on Europe, 34% on China, baseline tariffs already in over the weekend, and we're still sitting here on Wall Street having a debate as to whether these are negotiations or the new rules of the game.
It begs the question, where would markets be if people believed that these were the new rules of the game? That is ultimately the question that I have at a time where clearly there are many people who believe this is still just a negotiating tactic.
Dan, can you help us answer that question?
Well, I think it really also depends on the point and the direction of travel we're coming from in the U.S. I mean, we were coming from a point of 3% plus growth that was largely government and fiscal oriented. And so we're taking a tremendous amount of near-term painful medicine to try to reorder things that had been in place for many years. So I don't want to diminish by any means the gravity of the moment and what's going on. I also just think that we were playing with, or we had a starting point of fairly decent cushion to begin with.
Just to be more specific, how much more downside is there on U.S. equity markets if these tariffs are not negotiating tools, but they are actually the ultimate goal?
If they're the ultimate goal, then we have to reset earnings much lower. So if you just do simple math, earnings could be washed out this year. We were expecting 10% earnings growth at last glance before the last several weeks. So if you had zero earnings growth and multiples reset lower from that, you could be dealing with probably another 5, 7, 8% downside from here in the S&P. Now, who knows as well how delayed a tax deal would be. That could certainly be something that could change sentiment on a dime. So we're waiting and seeing with a very close eye on all these things.
Certainly part of the conversation over the weekend. Dan, fantastic to get your view on things. Thank you, sir.
Thank you.
Dan Skelly there of Morgan Stanley. Equities recovering a touch. We're down by 1.8%. So, new rules of the game or negotiations? Neil Dutter, his take. You either think tariffs are a means to an end or an end in and of themselves. The sooner everyone realises that it's probably the latter, the sooner we can start talking about getting back in to this market.
Because we've heard that from the president. We've heard that from a lot of people. The idea of tax cuts as an offset, I think, is going to get increasing attention. You are seeing that as a parallel down in Washington, D.C. The only issue with that is this is an extension of what's already in place. Are they going to add additional sweeteners, and can they afford to do that in a way that truly does offset sentiment in some sort of material way?
We'll get the view from Annmarie in Washington, D.C. in just a moment. In the meantime, let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Traders are boosting expectations for Fed rate cuts this year, now pricing in 125 basis points over the next 12 months. Swaps at one point priced in 40% odds that the Fed does an emergency 25 basis point cut next week before its next scheduled policy decision on May 7th. President Trump was close to an agreement with ByteDance over the TikTok ban in the U.S. Sources telling Bloomberg that the deal was called off after China withheld its approval following the announcement of reciprocal tariffs. On Friday, President Trump extended the deadline for the sale of TikTok's U.S. operations for another 75 days. And in sports, the University of Connecticut's women's basketball team won the NCAA women's basketball title again. The Huskies defeated the South Carolina Gamecocks 82-59 to capture their 12th title. The Huskies now stand alone as the most winning team in college basketball history. Their 12 NCAA championships are easily the most in women's or men's basketball. And that's your brief, John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the programme, the president isn't blinking.
What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Wall Street's taking the medicine. Equity futures down another 1.6% and recovering. Henrietta Treyz of Veda Partners joins us next, live from New York. Good morning. The message from the president this morning, the Federal Reserve should cut rates. Equity futures at the moment down by 1.8%, recovering a touch. We're down by 2 percentage points on the Nasdaq. Check out the bond market. We are pricing in those Fed cuts. The 2-year yield is down by another 7 basis points. On the 10-year, though, just about unchanged on the session. Lots of coverage of that maturity throughout this morning on this programme. The 10-year, 398.85. Under surveillance this morning, the president isn't blinking.
Because of the tariffs, we have $7 trillion already committed to be invested in the United States. What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. I don't want anything to go down, but sometimes you have to take medicine to fix something.
Here's the latest this morning. Trump and his economic team remaining defiant, backing sweeping global tariffs, insisting an economic boom is on the horizon, even as global markets melt down. Annmarie was on Air Force One right in front of the president when he made those comments. Annmarie, he is not blinking. He wants Chairman Powell to do some of the work.
He does want Chairman Powell to do some of the work. He reiterated that this morning in a Truth Social post, talking about the fact that oil prices are down, interest rates are lower. It's time, he says, for the slow-moving Fed to cut rates. Jonathan, on the way down to Palm Beach over the weekend where the president was, he also talked to reporters. And at the very end, I asked him again, what do you think the Fed should be doing as money markets are now pricing in more Fed cuts? And he said, look, I love that interest rates are coming down. I like that gasoline prices are coming down. This is the message he wants to project. He does not want to talk about equity markets. He made that very clear to me yesterday on the way back to Washington, D.C. when I asked him, is there a threshold? Is there a threshold of pain this administration is unwilling to tolerate when it comes to the tariff regime? And he said, look, I don't want anything to go down, but sometimes the medicine has to be prescribed, and that's what we're seeing right now. And it seems like they are willing to hold when it comes to this tariff plan and those tariffs coming in April 9th.
Annmarie, it's one thing to take a look at what's going on in equity markets. It's another thing to take phone calls from executives around the country saying, hold on a second, think about what you're doing and tell me what your actual plan is, because it is hard for me to figure out how to arrange my business. Annmarie, is there any sense that this White House is aware or concerned about some of the feedback they've been getting from the corporate community?
Look, I think they're very aware. Just look at what's also going on X, on Twitter, with Stan Druckenmiller and the likes of Bill Ackman coming after the administration, saying that the tariffs are just too aggressive. The president, though, on Air Force One did tell us that he spoke to about 4 or 5 tech executives over the weekend. He seemed to think that, at least what he told us, that some of them like what he's doing, standing defiant and trying to fix these imbalances. Really, the message I took away from that gaggle with the president is that there seems to be a new line in the sand, a new red line when it comes to what they want out of this, when it comes to the tariff proposals, and that's to eradicate trade deficits with the United States.
Annmarie, they couldn't have been clearer over the weekend. Appreciate your time as always. More from AMH later this hour. Equity futures at the moment down by 1.9%. To build on this conversation, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, welcome to the programme. Nouriel Roubini was with us last night, and Nouriel made the argument that we're in a three-way game of chicken. Trump, Xi, Powell. And we asked the question, Henrietta, that we're going to ask you. Who blinks first?
Yeah, I mean, the weakest link there and the efforts that are existent on Capitol Hill around pressuring President Trump are virtually non-existent. I don't get any indications from any of our contacts over in China that President Xi is planning to do anything other than continue to challenge and go tit for tat. And that creates a very difficult dynamic for Chairman Powell. But I want to stress to investors this morning that there is no activity in Capitol Hill around restraining the president in any meaningful capacity. When you're excited about 6 or 7 Republicans in the Senate who used to be pro-free trade and oppose tariffs, signing on to legislation that in 60 days might act to restrain him, you're nowhere. So there is not an external pressure catalyst on President Trump right now to pull these tariffs back. And we should operate as though they are real and get over this idea of this being just a ploy. This is real. It is happening.
Henrietta, can you elaborate on that? Because this has been one theory that's posited, that maybe some of the Republican congressmen could come out and take back some of the power of issuing tariffs. What makes you confident that that's not going to happen, given some of the feedback that some of the constituents are getting, that some of the Congress members are getting from their constituents?
You know, I talk to members and their staff all day, every single day. I spent the weekend with them as well as with investors. And there's sort of this incredulous feedback loop that there is going to be some sort of movement on the House Republican side where their main source of consternation right now is the Senate budget, not any of the tariffs, despite the fact that when they go home, it's a huge issue. And the thing that I would tell investors this morning is you have 4 days. They're going to be in session Monday night, tonight, Tuesday, Wednesday, Thursday, and then they're gone until the end of April. So unless and until the market or your voters back home can send you a message, you literally have 4 days, and then it's off to the races for President Trump with no restraint for the rest of this month. And that is a lifetime in the markets. And I cannot find a single member who's willing to do any sort of material protesting to call this all off. And it's not going to be enough to, reduce tariffs on Vietnam or reach a deal with Indonesia. That's not going to cut it. We are fundamentally reshaping the global trade economy, and there's no movement in D.C. to pull the president back from the ledge that he's walking us off.
Henrietta, just taking a look at the legislation that they are focused on, what does it look like in terms of the potential offsets to what some people are calling a tax on consumers by the levies? Is there a commensurate tax cut that goes beyond the extension of what we got during the last Trump administration?
There's not, Lisa, and I think this is the most important thing to focus on because it's the next pile-on question. Whenever you are unwilling to acknowledge that the tariffs are real, you say, oh, but there's going to be fiscal headwinds. The fiscal headwinds that exist in the Senate budget and the House budget are trillions of dollars in deficit increases from extending existing rates, a desire to cut an additional $1.5 to $2 trillion in entitlement spending across Medicaid, Pell Grants, food stamps, and TANF. And then there is an effort to pick little tiny pockets like raising the cap on the salt cap, raising the deduction on the salt cap to $25K from its current $10,000 rate. That is not sufficient to offset the trillions of dollars in losses and hikes to consumers from these taxes in the form of the tariffs. There is maybe, and I've done the math, a million different times now, maybe about $300 billion worth of new stimulus that you can get into the economy. That's not going to cut it. That doesn't even spread around to the 350 million Americans that we have in the country. So there's no stimulus that will offset the scale of these tariffs.
There are some people in the Republican Party that get it, some people around the president that get it too. Henrietta, we heard from Senator Cruz, who's warned about what this could do to the economy. And there appears to be some emerging discontent within the ranks, within the White House, between Elon Musk and the likes of Peter Navarro. Elon Musk is out on X this morning, posting videos of Milton Friedman arguing against tariffs. Henrietta, is that one to watch? How do you think it's going to play out in the coming days?
Where was Elon Musk 2 weeks ago or 2 months ago when we were crafting this entire strategy? Everybody comes on and says it, but if you followed President Trump on the campaign trail or in the first term, the resolve and the belief in these tariffs is overarching. I would say, watch the EU auto sector. This is an area that he has fundamental core disagreements and believes the United States has been taken advantage of. I see no scenario where the entire auto sector is not upended because these tariffs go into effect. And it's so entrenched in the street right now that there's a view that there's going to be an auto bailout. So you mentioned Ted Cruz. I cannot fathom Ted Cruz crafting an auto bailout for the U.S. auto sector as President Trump puts 25% tariffs on the EU or Japan or Korea or Canada or Mexico. It's not in their DNA right now. And I would also go a step further and say almost 80% of the House Republican Conference was elected in the wake of TARP, in the wake of the auto bailout, and they got elected because they ran against it. So this fear or this hope that there will be, a stimulative effort or a bailout for farmers is one thing. We'll see that. But for individual sectors, as we get deeper into this trade unwinding, you're not going to see bailouts from the likes of Ted Cruz or, I think, most of the House Republican Conference.
Henrietta, appreciate your take. Thank you. Henrietta Treyz there of Veda Partners, 2 guests in the last 20 minutes. Are these the new rules of the game, or is this the start of a negotiation? Henrietta Treyz, new rules of the game. Dan Skelly, Morgan Stanley, potentially a new round of negotiation.
We talked about this with Neil Dutta last night. Why is it that this market doesn't believe that this is actually the new rules of the game and that this is simply a negotiating tactic? And he said markets like free trade and they can't imagine that anybody else doesn't. And that seems to be the sort of rude awakening that we are seeing this morning. And a real question, what does this market look like when people realize this might be just the new rules of the game?
We've got competing visions around the president as well. Elon Musk hopes this ultimately leads to freer trade, negotiate. Secretary Bernstein speaking to Tucker Carlson, articulating a grand vision that included tariffs. Rules of the game or negotiation. That's the judgment call. In the meantime, this equity market keeps gapping lower. We're down 2% on the S&P. Up next, Kamakshya Trivedi of Goldman Sachs from New York. This is Bloomberg. You've heard it repeatedly over the past few days from the president himself, the Treasury Secretary, that the focus is shifting from Wall Street to Main Street. We'll see how this works out for Main Street. But the message from the president over the weekend, very clear to Wall Street. We need to take our medicine. And overnight we did. Equity futures dropped as much as 5% on the S&P 500 this morning, down by 1.9. We're 2 hours away from the cash open. Let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. The most traded stock this morning perhaps should come as no surprise. It is NVIDIA with volume surging and trades to the downside, down 3.6%. Torsten Slok of Apollo writing, it's not surprising Mag 7 is under pressure. 50% of their earnings come from overseas compared to 40% for the rest of the S&P 500. Hedge fund darlings in general also getting slammed with reports of margin calls. Also under pressure, it is not just tech. It is also the banks. Goldman Sachs down more than 2.5% after already an ugly past 2 days. Morgan Stanley downgrading the stock, saying that this is the bad kind of volatility. It is bad for their investment banking. It is bad for management fees. So that's why they are under pressure. Now, if you want to find a stock that's doing well today, it's difficult to do, but I do have one for you, and that is Dollar Tree. Those shares up 1.2%, one of only 14 stocks in the S&P that are higher in the pre-market. Citi gives us an upgrade, moves it to buy, saying that they have a little bit of space to rise prices. In a world where all retailers are raising prices because of tariffs, names like Dollar Tree benefit because value-oriented consumers will still go there, even if tariffs mean that prices need to push higher, John.
Danny, great work, as always. Danny, on some of the single names to watch for this morning. Equity futures recovering just a touch. Session highs in a session like this one is down 2%. Go figure. On our radar this morning, President Trump striking a defiant tone on tariffs, telling market participants, quote, sometimes you have to take medicine to fix something. Trump defending the rollout, saying he won't strike any deals unless they eliminate trade deficits.
This is the difficulty for so many different people. Where are the off-ramps right now? We keep talking about this. You mentioned it's a three-way game of chicken. That's what we heard about from Nero Rubini yesterday. Trump isn't backing down. Xi Jinping, from all accounts, isn't backing down and is ready to go for tit for tat. Powell has come out, made his comments clear. So at what point is there some kind of earnings call that could potentially shift the logic, or do we have to start pricing this in? This is the reason why I thought the most crucial quote came from Deutsche Bank, from Jim Reed and David Fokerts-Lando, saying the next few days are going to be monumental for the global trajectory of markets in the years to come.
On Wednesday, the president said promises made, promises kept. His intention was pretty clear, to go big on tariffs in the campaign. Drew Mattis of MetLife wrote in moments ago and said the president promised reciprocal tariffs. Now, reciprocal tariffs was something very different to what we actually heard on Wednesday, which was a very crude methodology that was all about trade deficits. So it feels like with this administration, comparative advantage is just totally out the window. That if you have a trade deficit with us, somehow you have cheated. And therefore, we need to get that back down to zero. And I think Vietnam's a fantastic example of this. If Vietnam comes to the table and says, we'll get rid of all our tariffs, whatever's left of them, do you really think they can close that deficit, close that surplus they have with the United States? No, of course they can't. They can't import enough from the United States. That's not going to happen.
Right. So then, again, what is the ultimate goal? And does it mean just simply isolating the United States in a way that would completely transform the way people do their business? One silver lining, and we talked about this, is the postponement of the TikTok deal. And the reason why I find this somewhat optimistic is because if there was any hope of actually reaching a deal, then they would postpone it. Otherwise, why not just cancel it altogether and ban it in the United States?
Where it leaves China, I think, is a major question. Do they devalue? Do they lean on fiscal? We had a big conversation overnight in Asia about them leaning on fiscal, maybe a little bit harder. What they do next is interesting to me. So all the overcapacity that people have complained about, all the overcapacity that was threatening to land on these shores in America, that's not going to hit America anymore. Tariffs are going to be too high. It's going to hit Europe. It's going to hit everybody else. What does China do from here?
And does it have an economic or some sort of military overtone? I mean, not to go there, but a number of different hedge fund managers, including Kyle Bass, talks about what this means for Taiwan and the geopolitics of the moment. Look, it is difficult to predict how this is going to play out. So a lot of people are saying we're not going to because it doesn't make sense to keep going with this. So it's all going to get walked back. And that's the reason why a lot of people in markets just don't believe it.
This is only one part of the fuller policy platform. The other big piece of it are taxes. The Senate is advancing President Trump's tax cut agenda and moving towards increasing the U.S. debt ceiling. The budget resolution passing Saturday now allowing congressional Republicans to extend Trump's 2017 tax cuts. You ask the question, everyone's asking the same question. Is that enough? Can they? And are they willing to go even further?
And right now, the answer is it's not being embedded in that plan. If you think of a $25,000 cap to SALT deductions, that isn't going to cut it, as we just heard from Henrietta Treyz. This isn't actually some sort of stimulus. This is an extension of the status quo. At that point, how much of an offset could this be? We heard from Dan Skelly of Morgan Stanley that this could potentially shift the sentiment on its own. Can it?
Lower interest rates would be an offset. Lower commodity prices would be an offset. We're certainly getting lower crude prices. Crude breaking below 60 in the last day or so. Yesterday evening, 59 handle on WTI. The drop coming as Saudi Arabia cuts its selling price for May by the most in over 2 years. This just days after OPEC Plus announced an unexpectedly large output hike. So we've got two issues colliding with one another. The threat of softer demand colliding with the reality of maybe additional supply.
So what's the why here? And I spent a lot of time over the weekend trying to understand what Saudi Arabia's motivation is. Is it an olive branch to the Trump administration to say we're on board with you to bring down oil prices? Is it trying to punish some of the OPEC members for producing more than their quotas are and saying that we're going to take away some of your profitability? Is it to solidify their role in global markets? Or is it in response to something that they see coming down the pike? Either way, oil prices are going down, yes, but not necessarily for the right reasons or as a reliable tell about what that means going forward.
We've seen them fight for market share before, and I wonder if that's what's happening now. Brent right now is at 64, WTI at $60 and about 60 cents. Let's turn to foreign exchange. Goldman Sachs expecting the yen to strengthen to the low 140 levels against the dollar this year. Global FX and interest rates head Kamakshya Trivedi saying the yen offers investors the best currency hedge against increased recession chances. Kamakshya joins us now for more. And there's certainly increasingly odds of a recession on the cards here, Kamakshya. And I just wonder whether you still believe that is the best hedge for this moment.
Good morning. Yes, I do think that the yen is one of the best hedges in this type of environment. We have long maintained that the best environment for the yen is when U.S. equities and U.S. rates fall together. And yes, they have fallen a lot already in the past week. You've had some monumental moves in the last couple of trading sessions. But even with these levels, for example, of rate shifts, you're still above the levels where you were, for example, in August last year when recession risks were thought to be pretty high. We think that recession chances are higher now than they were at that time. We raised our probability of recession to 45% over the weekend. And in that type of environment, when you're seeing U.S. equities, U.S. rates go down together, the yen tends to outperform. There's also a more micro reason, which is that if you look at the last few days, the dollar-yen exchange rate, in fact, has actually done less than you might have expected given the move in the rate differential between the U.S. and Japan. And so I think that's another reason why we think the yen is a very good hedge for the kind of macro environment and the market sessions we are likely to be in the coming days.
Kamakshya, what about the rest of G10, ex the Japanese yen? Let's just sit on that for a moment. Typically, if we reprice the global economic cycle and price it for a recession or an economic downturn, we'd start to think about broad-based dollar strength. Do you believe it's different this time?
I do think it's different this time. I mean, what you're referring is to the left tail of the dollar smile. We think we are a little bit away from that. If you look at how the markets have priced things, month to date, week to date, it has been very much in the nature of a U.S. growth shock. You've seen this kind of very dramatic increase in business uncertainty, consumer uncertainty, primarily in the U.S. on the back of, what looks like a trade war. You've also seen a very significant tightening in financial conditions. And so, given the dollar's strong valuation, given the sustained and large-scale positioning in dollar assets, we think that is still likely to be the primary channel of adjustment here. We think that the weakness you've seen in the dollar can persist, can deepen further against the rest of G10. Yes, there is some risk that if this, U.S. shock morphs into something that is much more liquidity-driven, market stress-driven, that, then goes on to the rest of the world, that you start edging into the left tail of the dollar smile. But I still think we are some way away from that.
How much are you taking some signal right now from the fact that, as we've been talking about all morning, we haven't seen as big of a rally into the long end of the U.S. yield curve, even now, than many people would expect, given the risk-off tone in equities?
I think that is important. And I think that, in a way, normally you would think that is the buffer or the offset, if you like, to some of the shocks that you're seeing. But I think it is, again, the nature of the shock we're facing. The complication with the tariffs is that not only do they cause this uncertainty that sort of compounds the risks that, make us worry about recession, but they also raise prices, that you see inflationary impacts from them. And so that puts the Fed in a much more difficult position. Now, we do think that, if and you see a kind of broad-based and deep deterioration in the labor market, you will see rates come down. But I think you're going to have to be more patient for that. So not just the put from the administration, but the put from the Fed also feels that much further away. And that, I think, makes the path for equity markets, for risk assets, that much more complicated.
Kamakshya, we've been talking about potential circuit breakers again and again. It's not coming from Jay Powell. It's not coming from Donald Trump. It's not coming from Xi Jinping. Is there a circuit breaker that is actually the circuit breaker, that is fissures in a market that ends up dysfunctioning and requires some sort of response? Do you see any signs, any evidence that could be happening even on the margins?
I think so far, you have seen some circuit breakers in some markets and so on, but, by and large, you've seen a kind of broad-based pressure, that has been, relatively, orderly. It's always hard to use that word to describe the kinds of moves that we have seen, which, as I mentioned, are truly historic. But, again, the dollar move lower, it's been going on for some time, even before, these latest round of reciprocal tariffs were implemented. You've seen some pressure on the equity market also predate this, but there's no question that, if we see, a compounding of these risks from the kind of weak level of growth you're already starting at, that you could at some point see the kind of market pressure that, leads to the kind of situation you're describing, one where stress levels, liquidity, illiquidity pressures start to come in and start to build up. We aren't quite seeing that yet, but it's still early in the week.
Can we just build on that? That word orderly. If this is orderly, what does disorderly actually look like?
Yeah, I think, you start to see the kind of breaking in the market stress indicators, some of the liquidity indicators that, you typically look at this type of, when you have these kinds of measures. That's why I mentioned, I think that, if you see the continuation of this, there is still, I think, some hope, some risk out there that, before the 9th of April, you see some walking back, or perhaps the full set of tariffs that were announced maybe don't go into play. But I think if that does happen, as has been announced, I do think it's going to be hard to avoid, further moves down in the market. And at that point, it could start to become disorderly.
Kamakshya, appreciate your take as always. Thank you, sir. Long week ahead of us all. We've said that repeatedly. Kamakshya Trivedi there of Goldman Sachs on the Federal Reserve and what it would take for them to reduce interest rates. Colby Smith out of the New York Times at the moment, just writing that perhaps put more data than this market believes, Lisa, and that it might take a while to get sufficient evidence that the hard data is broken for the Fed to step in, which could mean this Federal Reserve moves much later than this market anticipates. As for the market stress. So we've reminisced about what happened back in late 2018 when we saw high yield spreads gap a lot wider. What we also saw in December of 2018 was the high yield market totally seize up. Not a single issuer came to market in the United States that month, and that woke up the Federal Reserve. They're the kind of things to watch, I think, this time around as well.
We are seeing credit widening continue for a third day. If you look at some of the derivatives contracts, at the same time, people are ratcheting back their expectations of some sort of Fed response. Either way, to Colby Smith's point, right now, Fed funds futures pricing in about 4 Fed rate cuts by the end of this year. Watch this space when we hear from the Fed's Kugler later this morning, and a whole host of Fed speak throughout the week.
The next decision on May 7th from the Federal Reserve, and May 7th feels like a lifetime away. Equity futures on the S&P 500 negative by 2.4%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs economists have raised their 12-month recession probability, now at 45%. They've also lowered their GDP forecast. They also expect the Fed to deliver 3 consecutive 25 basis point insurance cuts beginning in June. A check on Tesla stock extending losses this morning, down 6.5%. At one point, it dropped below a price that Commerce Secretary Howard Lutnick predicted that they would never fall to again. He made the comment on March 9th on Fox News when Tesla closed above $235. Lutnick encouraged viewers to buy the stock at the time. And the weekend box office got a much-needed boost from a Minecraft movie. The film, based off the namesake video game, smashed its opening weekend, earning a staggering $157 million in ticket sales from the U.S. and Canada. It was the best opening for a movie so far this year. That's your brief, John.
Danny, thank you. Appreciate the update. Up next on the program, sticking with the game plan.
There's no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade.
That's what he's attempting to do. Up next on the program, the former senior Trump trade advisor Kellyanne Shaw, live from New York City. You're watching Bloomberg Surveillance. This right here is what calmer waters look like these days. Equity futures down 2.5%, down 5% overnight, down 6% Friday. On Thursday, down by 4.9%. The biggest sell-off we've seen going back to the pandemic. On the Nasdaq, down 2.9% on the session. Under surveillance this morning, sticking with the game plan.
There's no postponing. They are definitely going to stay in place for days and weeks. The president needs to reset global trade. The countries of the world are ripping us off, and it's got to end. The president has made it crystal clear. This is the policy we're going to protect. The factories that come build in America, we are going to protect them. They're going to be successful.
So here's the latest. They're sticking with the plan. 10% baseline tariffs already active. Reciprocal tariffs kicking in on April 9th. Just 2 days away. Joining us now from Washington, D.C., Bloomberg's Annmarie. Annmarie, good morning.
Good morning, Jonathan. The White House defiant and really digging in when it comes to their tariff proposals. And those tariffs are set to take place. And one thing was very clear when the president was gaggling with us reporters last night on Air Force One, and I was there. He said, I'm willing to make a deal when it comes to China, but they have to solve the surplus. This has now become a line in the sand for this administration. Trade deficits. We have one of the most important people to discuss this morning, Kellyanne Shaw. She's a former senior White House trade advisor, so really can try to help us understand, read the tea leaves of what's exactly going on. I asked the president yesterday a few items, but one thing when I asked him was, is this a negotiating tactic? Is this the start of deals, or is this rules of the road? These tariffs are here to stay. And he didn't want to answer. What do you make of that?
Yeah, good morning. And I think it's really interesting that of all of the 6 cabinet level officials who went out on the Sunday shows yesterday who were asked the exact same question, they all punted on that as well, right? So this is the message coming out of the White House. We're going to keep it ambiguous. We're not going to tell you exactly what's going on. And part of that, as a former U.S. negotiator, is that if you really are negotiating and that's your bottom line, you don't want to broadcast that to the world. And so my read on this is that the president is keenly focused on the trade deficits, that 10% global baseline tariff is intended to stay with respect to almost all of our trading partners for the foreseeable future, but that there is negotiating room on some of those higher tariffs, provided countries are willing to come to the table and fix not just tariff, but non-tariff barriers.
So the ambiguity helps if you're someone like you in Trump 1.0. You're at the table and you need leverage negotiating a deal. But how much pain do you think they are willing to really withstand in the financial markets to get to that endpoint?
Well, I think it depends. And so right now, all of we've seen so far in terms of the president's economic agenda are these tariffs. We haven't seen the tax cuts. We haven't seen the deregulation, at least the total implications of everything they're doing. We haven't seen cuts to fiscal spending. We've seen energy prices going lower. The administration will point to the jobs figures, which were very good last month. So they're hoping they can ride this out. And the president's asking the American people for a long leash. And that's what's happening right now. And we'll see if the American people give it to him.
Right. He's been saying this term, hang tough. It's going to be a little bit of pain. He said yesterday to me, sometimes you need a little bit of medicine, and that's what we're doing right now. Do you think any trading partner will be able to negotiate below that 10% barrier they basically put across the board?
Potentially. I mean, if you look at countries like the UK or Australia who have trade surpluses, or the United States has a trade surplus with, and there are specific issues, specific non-tariff barriers that the United States is concerned about, beef in the case of Australia, some of the tax issues in the case of the UK, there may be scope for a deal there. But if you look at the legal basis for this measure, these IEEPA tariffs are based on the trade deficit. So I think countries with whom the United States has a trade deficit are less likely to get out from under some of these 10% tariffs than countries that do.
Do you think there's going to be legal challenges or congressional challenges to all of this?
Well, we've already seen the first legal case, at least with respect to the fentanyl tariffs, which was filed. And I would imagine that come April 9th, somebody is likely going to file a legal challenge to this next set of tariffs, these reciprocal tariffs that are going to go into place. But, the president has broad authority under IEEPA, and I don't think that the administration is particularly worried about these legal challenges, at least not yet. And on the congressional side, we don't have a majority of Republicans on the House who are willing to vote against the president, at least not right now. And I think that majority will hold for quite some time. Now, at some point, that may run out, but I do think the president has a bit more in terms of political grace here.
The next step for trade for me would be potentially this phone call. Japanese local press is talking about a phone call the prime minister is going to have this morning with the White House. And then also Benjamin Netanyahu, the Israeli prime minister, will be at the White House. He met with Howard Lutnick, the commerce secretary, yesterday. Could we see deals as soon as, say, this week, or is that too soon?
Well, and that's something that's also interesting, too, in terms of what those 6 cabinet secretaries said on TV yesterday, that they all highlighted that over 50 countries had contacted the White House seeking some sort of deal. So clearly they are entertaining something. But the other message is that the issues that they care about, which are predominantly these non-tariff barriers, won't be fixed in days or weeks. So they're forecasting months into the future in terms of when we might see some of these deals. But if, again, there are specific issues with specific countries, I wouldn't be surprised to see a few deals evolve in the near term.
Do you have a list in your mind of who potentially could get the first handful of deals?
Well, I think certainly some of our major trading partners. So if you are a small country or an Antarctic island, you're going to be pretty far down the list in terms of the countries that the administration would be negotiating with. But their eye is going to be focused on countries like China, Vietnam, Malaysia, Japan, South Korea, the EU, some of the countries, again, with whom we have these large systemic and sustained trade deficits.
But some of those smaller countries, how do you get to balanced trade? Madagascar, I think it was a 47% tariff. Their capita per GDP is $500. In the U.S., the capita per GDP is, $80,000. How do you get to balanced trade with a country that is economically disadvantaged?
Yeah, I think some of these things are challenges. The perspective of the administration would be that we're a bigger economy. We should be exporting more to you than you are to us. But they have some choices to make. They're going to have some trade-offs. And for most of the countries in the world, it is this 10% baseline tariff, which I think most countries won't get out from under at the end of the day. But for some of the smaller countries, they're certainly going to have to try in terms of trying to negotiate some of these higher tariffs on down.
Kellyanne, thank you so much for joining us this morning. Jonathan, Kellyanne Shaw, former trade advisor during the Trump's first administration. Key takeaway from me, she nailed it right there. Everyone's punting whether or not this is a negotiation or, as you call it, new rules of the road.
We've had 2 different views already this hour, and there's another one for you. Annmarie, thank you. It's so hard to negotiate because of the crude methodology that was unveiled last week. What is the objective? Removing all your tariffs is one thing. Giving a plan to eradicate the deficit is quite another. It's very difficult to do the latter.
Yeah, given the fact that some of these economies are not feasible, cannot feasibly meet that goal, what I took away was that the penguins and the seals are going to have a hard time.
I think if you're living on the Antarctic, you've got other problems, to be honest with you.
I don't know if there is.
Maybe it's another morning for jokes, I don't know, but come on. Up next on the programme, Laurie Calvasina of RBC, Syth of Raymond James, Michael Gapen of Morgan Stanley and Meghan Graper of Barclays. From New York, the third hour of Bloomberg Surveillance. Up next.
Financial markets are incredible discounting machines, and they're discounting the future story. And that's really about this tariff story.
If these tariffs stay, all bets off, because it changes the whole paradigm.
There is a hope trade, though, in the market. I think the hope is that this is the start of negotiation and that this is actually not going to stick.
Tariffs are going to be high, and I think they're going to be high for a while.
The hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The journey so far, and thanks for that, Mohammed, incredibly bumpy. Live from New York City this morning, good morning, 90 minutes away from the opening bell and that hope trade getting obliterated once again overnight. Negative 5% this morning off the lows, down by 2. On the Nasdaq 100, entering a bear market, down another 2.3%. In the bond market, pricing in more rate cuts at the front end of the curve. Yields lower by 4 basis points, 3.61. The 10-year unmoved. The surprise of the morning so far, the 10-year 3.9923. Even with these moves in the commodity market, crude lower again in 3 sessions, down around 16%. Down 2.5, back to about 64. A break of 60 overnight on WTI, $60.30. And a whole new list of downgrades on Wall Street. Massive list of them. Here's 3. John Stolfus, Oppenheimer. He goes down from 7,100 to 5,950. Evercore down to 5,600 from 6,800. And the latest to join that growing list, JP Morgan, coming out with this one. 5,200 from 6,500 previously. And Lisa, when you put it all together, when you look at all those numbers, what do they all have in common? They still believe this market ends the year higher than where we are right now.
That is exactly where I was going to go with that. They still are in the 5,000s, okay, as a base case, which is pretty optimistic considering where we are right now. Look, we have said this again and again. There is a battle brewing between Wall Street, which does not believe that these tariffs are going to stick, and policy analysts who are saying there is no reason to think that they're going to be backed off anytime soon. You put those two together, they're on a collision course, and frankly, it's the reason why people don't want to catch a falling knife, and you're still seeing losses after the worst 2 days going back to March 2020.
You see this in single names as well. Apple was down 16% in 2 days. That's something we haven't seen since 2008. And when you look across the coverage of the name, Rosenblatt, not just to pick on them, not picking on anyone here, it's hard for us to imagine Trump blowing up an American icon. That suggests something is likely to give. People believe that this will be so bad. Maybe it won't, but people believe it will be so bad that it just won't happen. And that's why they're clinging to this belief that it's a negotiation and not the new rules of the game.
And if you listen to President Trump, what he said was that the CEOs of tech companies called him up and said that actually stay hard. This is going to keep working. I think that what you're doing is right. So put these messages together and you don't get any kind of conclusive answer. Question going forward is, and you raised this really interesting question over the past couple of hours, what is going to be the consequence for U.S. markets going forward, given the fact that we are not seeing that rally in longer term bond yields? I just want to put some perspective on this. Since August 2nd, we have seen almost 40 basis points of a rally in 10-year Japanese yields, almost 20 basis points in German 10-year yields, 14 basis points in U.S. 10-year yields. What is the pressure valve in the U.S. that can take some of the steam out of the system if it isn't necessarily a rally in long-end Treasury yields?
Nouriel Roubini said this is a three-way game of chicken. Trump, Xi, Powell. Powell going into the weekend not blinking. What would it take to get this Federal Reserve to come to the table? Because we're not seeing it just yet.
Something breaking. That is what people have said, and that's what happened back in March of 2020. Remember, they cut by 0.5 percentage point initially in response to the pandemic, and then another emergency cut down to 0 subsequently, less than 2 weeks later, ahead of a meeting that they had planned. If they have that kind of response, is that going to be a positive for markets? Will that be a relief valve at a time when that doesn't necessarily consolidate the actual issue, which is, are we facing a new trade regime?
The opening bell 1 hour and 26 minutes away. Equity futures off the lows, but still a whole lot lower. Coming up this hour, we'll catch up with Lori Calvasina of RBC on why her bear case is now her base case. Syth of Raymond James as tariffs weigh on airlines, and Michael Gapen of Morgan Stanley on the likelihood of a global recession. We begin this hour with stocks lower following their biggest 2-day plunge in 5 years. Lori Calvasina of RBC writing, we are lowering our year-end 25 price target to 55.50 from 6,200, essentially making our old bear case our new base case. Lori joins us now for more. And Lori, I have to say, that old bear case, which is the new base case, is sounding like the bull case based on the moves we've seen over the past few days. How you've reflected on things over the weekend?
It's a great question, John. I was actually talking to my energy trader, and the days are all bleeding together at this point. I think it was on Friday. And, you know, we sort of discussed how we went from stagflation in terms of people's thinking to recession in about 2 seconds. And I've never seen anything like it, where you've just seen the mentality shift so much, so quickly. But I will caution you, that is what happens in growth scares. And that is what we are smack dab in the middle of. The 17.4% drawdown that we saw as of Friday was exactly in line with the average drawdown that we saw in 2010, 2011, 2015, 16, and 2018. Of course, that 2018 went all the way down 20%, which would take us to around 4,900 on the S&P this time around, I think just a touch under. And so this is what it feels like. We have this tiers of fear framework we've talked about to help us navigate. We're in tier 2. Tier 1 is the garden variety pullback. Tier 2 is the growth scare. Tier 3 is recession. And so we have increasingly been talking to people, if we break through that 20% number, what does recession look like? If you look at the average average and the median drawdown, it's about 27 and 32%. It's taking it to 4,200, 4,500 on the S&P. We could do that. It's not unreasonable to be thinking about that.
Laurie, we know how to price growth scares. We're OK at that. We're fairly decent at knowing what a recession might look like, though we haven't seen many over the last 20 years. That's a shock to the cycle. The issue that we've been trying to get our hands around is how to price a shock to the system. Because if these are the new rules of the game, this is a change we haven't seen for decades, Laurie. How different is that?
So I think it's a great question, John. And as I've been, talking to investors over the past month, and we were talking about how that tier 2 fear was rising. One of the thoughts that occurred to me, and I didn't like to say this out loud all that often, but it had felt a bit to me like this was January of 2020, where there was something coming that we didn't quite know what it was. I will give you one bit of, comfort from that 2020 period, which was that ended up being a garden variety recession in the 30s in terms of the drawdown from peak. And I know it doesn't make us all feel happy for me to say that out loud right now, but it does give me a little bit of comfort. If you really want to talk about big crises, we don't have a big sample size on those. We've got things like the tech bubble. We've got things like the GFC. You basically see the market lose half its value. I'm not saying that's what's going to happen, but as we sort of explore, the depths that we could go, that is the one outside of recession that you want to look at.
You said, Laurie, in your recent note that full recession pricing could be a drawdown of some 27 to 32% based on historical standards, which would take the index down to 4,200 to 4,500. What would you have to see to start entertaining the idea of that being a base case?
So, look, I think the street, and we talked about this in our target note, we changed our target on Friday morning. It was clear to us on Thursday that things were not going to hold in that garden variety territory. But the reality is that the street right now is really doing a lot of hard work modeling out what the economic impacts are. And so we've got the impacts from the tariffs, of course, but then we've also got secondary impacts, right? We've got impacts from all the uncertainty we've just had. We've got secondary impacts. Even if the tariffs get dialed down, there's still secondary impacts from the uncertainty that will be there going forward. This is a very, very tough thing for the economics community to model. They're working through it now. And I will remind you, Lisa, a week ago, we were also all sitting here saying we've seen all this deterioration in the soft data. What about the hard data? We still haven't really seen any hard data yet, for the recent impacts of all that uncertainty. So we need that baseline to come out in this hard data to really understand what the damage is going to be.
At the same time that we're talking in these sort of catastrophic terms, I want to go back to the call that you actually made, which is gains on the S&P through the end of this year. What gives you hope or confidence that actually there is going to be some sort of rally? What is the relief valve that you think stymies what this is, as you frame, a growth scare?
So look, there are two things that you can look at. One of them I buy into, the other that I don't. I think that the thing that, and we've seen strategists, start to take their numbers down. A lot have not. And I think one of the reasons why a lot have not is because there is an understanding, if you've been in this business long enough, that as fast as you go down, you can rally just as fast on the other side once something happens, once there's some sort of policy intervention, once there's some sort of change. And so I think that's keeping people, somewhat, I don't want to use the word complacent because that's not what it is. It's a legitimate thing to worry about. But I do think the trigger in terms of the fundamentals for that is this idea that we get back to tax, that we get back to deregulation, that somehow this storm passes and we get to the promised lands of those business-friendly things. I'm not so excited about that. But I will tell you the thing in my modeling, Lisa, that sort of keeps me sympathetic to that kind of V-shaped type move, or at least on guard for it a little bit, is the idea that if you look at AAII net bulls, they are a very, very good contrarian indicator if you're looking on a forward, say, 9-month basis or 12-month basis. And we are down more than 2 standard deviations below the long-term average. We have been there since the end of February in terms of how lousy people have felt. That is similar to what we saw in 2022. It's similar to what we saw in the GFC. It's similar to also what we saw in the 1991 recession. If you go back to the fall of 2022, there was despair running around the street. We had something weird happen with that inflation spike. It wasn't quite a recession. It ended up being a great buying opportunity that nobody, could even entertain in terms of kind of writing the sentences out on paper. But that indicator, that just sort of contrarian impulse, I think is something a lot of people in the strategy community have in their minds.
Laurie, help us navigate the earnings still to come. So on Friday, we were going into the hard data looking for payrolls. Payrolls came and went. No one's talking about it. No one's mentioned it. For the whole of this morning, for the whole of yesterday when we did special programming, the payrolls number didn't even come up. We moved on quickly. This week it's about earnings. Are we going to have the same behaviour towards earnings this week when we hear from Delta Airlines on Wednesday, from the banks on Friday? What would you use earnings this week for? Can they offer any guidance?
So John, I don't think that the earnings this week are going to offer much guidance beyond the banks themselves. I think the airlines always give us some interesting clues, particularly in regards to consumer behavior. So, of course, we want to pay attention to that. But, to be honest, the banks are not at the center of this storm. We might hear some things in terms of trading volume and whatnot. But we knew, back in early March at our financial conference that the banks were in pretty good shape. They were cognizant of what was going on, and they felt like they could manage through. So do we see any deviation from that message? That'll be one thing to look at. But really, John, what we care about is week 2, week 3, week 4. Week 2, we get more industrials. They're really more at the center of this storm. We need to hear what they're saying in terms of how they manage their supply chains and pricing. You're not even going to get consumer companies till the end of this reporting season. You might have a few sprinkled out throughout, but this can be a long slog. There's a lot of hard work to be done. Companies have done a lousy job of giving the sell-side analyst community guidance on how to think about tariffs, because that denialism you talked about, John, the companies have been guilty of this as well, and it's really frozen a lot of the people who cover stocks on the street, because when they don't understand what the sensitivities are, they can't model it. And I will tell you, I read a lot of transcripts. Companies have not wanted to talk about anything until it comes reality, and we're just now having that reality hit them in the face.
Laurie, you don't have to answer this question if you don't want to. I don't want to put you in a tricky spot. But do you think that could be because these management teams didn't want to get on the wrong side of the administration? Do you think that was something that was driving their decision not to share their thoughts on tariffs? And do you think that'll change in the coming weeks?
It's hard for me to speculate on what that is. I do worry a bit, John, about financial markets. And, I'm an old political science major. I studied political theory. And so I'm a big believer in the free marketplace of ideas. And I do think we have to have a free marketplace of ideas on the street for financial markets to work well. But I think, to be honest, they have really just not wanted to talk about things until they knew exactly what they had to talk about. If we sort of look forward, I think the conversation is going to get started. But I will tell you, one of my analyst last week told me his companies, they're not going to be able to figure out this in one quarter. It's going to take a couple quarters. And that was not a comforting thought to me.
Laurie, appreciate your time, as always. Thanks for jumping on for us. Laurie Calvasina there of RBC. We'll hear from those management teams this week. And I think for many analysts, they'll just turn around on the call and say, well, these are the rules. 10% went in over the weekend, April 9th, because the bank earnings will come after April 9th. April 9th, the reciprocal tariffs are on. So based on that, what do you think happens from here? Now, you can sit here and say that we think there's going to be a negotiation, but I think you've got to offer some kind of assumptions about what it will do to the underlying business if those tariffs stay on.
And then how catastrophic is that potentially for the stock price, given some of the expectations? You asked her a really good question, Laurie, about whether you're going to see some pushback from CEOs, whether the potential consequences are enough to unleash their actual feelings rather than fear of some sort of blowback. That's the reason why I thought JP Morgan's Jamie Dimon was interesting, because even though he did address tariffs in this note, it wasn't scathing. He was just saying he hopes for a quick resolution because potentially it could boost prices and damage the global economy. This wasn't necessarily scathing rhetoric akin to what we heard from Bill Ackman.
This can cut both ways. Let's be very clear about that. We said yesterday on the special, I think you've got to be very open-minded about what can happen here. A lot of people had very strong convictions in the pandemic about what some of the policies might mean for the economy, what the downturn would mean for the broader economy and the market as well, and they were dead wrong. This can cut both ways. You could have a situation where some companies come out and say, yes, dreadful, terrible, we're going to be in a bad position, can't move the factories from Vietnam, wage differentials too large, all of that. Could be in a situation also when some people come out and just say, look, these are the new rules of the road, we spoke to the administration, these are our capex plans. I don't know if we get that as soon as this earnings season. You might have to wait a number of quarters before they can outline new plans, but it's something worth thinking about in the months to come.
Especially because if they're trying to cater to public sentiment, how much do they have to not necessarily weigh in on the potential outcome, given that some of the criticisms are valid, et cetera, and just weigh in on what the outcome is in cut and dry numbers? We'll see.
The auto manufacturers are going to have to tell you where the plants are going to be and what they're doing to try and get around some of this. On Mag 7, May 1 is when you hear from Apple. This came from Torsten Slock of Apollo this morning. Roughly 50% of earnings in the Mag 7 come from abroad, with trade making up a bigger share of GDP in the rest of the world than in the US. The Mag 7 will be hit harder on their global earnings than other S&P 500 companies want to think about over the next month.
This is the reason why Dan Skelly said he doesn't think that that's going to be the one that leads in the way up. If these are the new rules of the road, any resurgence is not going to be led by the Magnificent Seven.
Equity futures at the moment down by 2.7% on the S&P 500. With an update on stories elsewhere with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Israel's Prime Minister Benjamin Netanyahu will meet with President Donald Trump in Washington in order to seek a better tariff deal. The two will also discuss the war in Gaza, the situation in Syria, and the Iranian nuclear program. Netanyahu will be the first world leader to meet Trump since he announced tariffs on more than 60 countries. Billions of dollars worth of IPOs are on hold as President Trump's trade war upends the global economy. Sources telling us that ticket platform StubHub, fintech giant Klarna, and trading platform eToro have all paused their planned listings as markets extend deep losses. And cryptocurrencies have wiped out almost all the gains they made since President Trump was elected. Bitcoin traded below $75,000 on Monday for the first time since November 7th. Options markets suggest that the selling pressure may continue. Demand is growing for further downside protection. That's your Bloomberg Brief. John.
Hey, Danny, thanks for that. Appreciate it. More from Danny later this hour. Up next, the morning calls, plus savvy Syth of Raymond James as tariffs weigh on airlines. From New York, that's up next. This is Bloomberg. The opening bell at 1 hour and let's call it 10 minutes away. Equity futures down by 3% on the S&P, rolling over just a touch again. On the Nasdaq down by 3.2, on the Russell down by 3.7. That's the price action. Here are your morning calls. First up, Dan Ives of Wedbush cutting his price target on Tesla by more than 40%. Capitulation, just about. Citing a brand crisis created by CEO Elon Musk, that name is down again by 7%. Your second call from Morgan Stanley, downgrading large and mid-cap banking sectors to inline, saying Trump's tariff policy increases the risk of recession. And finally, UBS downgrading United Airlines to neutral, seeing a more challenging economic backdrop. That name is down again, and we are lower by 4.6%. Let's stick with the airlines. Savvy Syth of Raymond James upgrading JetBlue to outperform following the recent sell-off, citing, quote, low bankruptcy risk and an M&A floor, especially against the backdrop of negative buy-side and sell-side sentiment. Savvy joins us now for more. Savvy, plenty of negative sentiment, that's for sure. Going into these earnings from these airlines, before we get to JetBlue specifically, just how bad is travel right now? Are you already seeing the damage done to some of the consumer activity?
Hey, good morning, Jonathan. Yes, what you're seeing is in February, you saw kind of a slowdown in demand, and I think it was just a reaction to the policy uncertainty. 1Q was also a tough a period in terms of weather for consumers as well, and a bad flu season. So there's been a lot of noise, and we've definitely seen kind of a slowdown in kind of the February, early March timeframe. I will note that spring break, Easter travel, those appear to be still intact, very strong. So a bit of a mixed signal on the airline front, and it really seems to be around policy uncertainty. We've seen a bottom in those trends, but the question is, given the news last week and the stock market reaction, is there kind of another leg down here yet to come?
Savvy, there's a question around consumer versus corporate. And originally it was consumers that were showing some hesitant, but also on the corporate side, a bit softer demand. Where is the corporate traveler at a time where you hear about a lot of uncertainty about future plans?
Yeah, I think, again, if you look at corporate demand, it's still up year over year. So it's generally still in a good territory, but there was a lot more stronger momentum exiting last year and into January. So a lot of slowing down in the momentum we saw from the corporate traveler. And now, given these kind of tariff headlines and very kind of uncharted territory, it'll be interesting to see how that progresses. The thing with corporate travel is usually it's not, it takes a little time for budgets to get cut. So I don't know if we're going to have an immediate clarity as to how corporate travel is going to progress. But we've definitely seen a little bit of kind of deer in headlights kind of action from corporate travel here in February, March time period.
Savi, all morning, John's been asking a great question, and so I'm going to steal it from him about what kind of guidance any of these companies can actually give, given that they have a real set of unknowns and, frankly, a real question about the blowback they could get from the administration. What do we expect to hear later this week from Delta kicking off earnings?
Yeah, Delta's not in a very enviable position because it's still very early on. I think the benefit that airlines have is you are heading into the summer, and it does seem like summer is really borne out by leisure travel. So I think there's at least a stronger base to kind of hang your hat on. A lot of those, especially international summer trips, have already been booked. So they have some base to go off on, but it's not an enviable position, especially if they're trying to update their 2025 guide, given the level of uncertainty. So they're probably going to have to look at kind of past economic downturns and try to put in a kind of a lower floor to help guide. And again, the other benefit the airlines do have here is fuel has pulled back, and that's their second largest cost. So there are some kind of nice offsetting tailwinds for airlines, but this is not an enviable position, and I'm not sure how much comfort investors will have in whatever Delta is able to guide to.
Savi, much of this conversation is about domestic activity and outbound flights. Can we talk about inbound just a little bit? We've seen some big headlines coming through, several reports over the past few weeks about declining activity from Canada into the United States. I've seen a similar thing about travel from Europe into the US as well. Just what exactly is going on there?
Yeah, man, you're definitely seeing that there's a sentiment impact from some of the positions that the U.S. has taken, and you're seeing that most particularly in Canada. But beyond that, I think there is some kind of uncertainty around what travelers can expect once they come to the U.S. that's causing maybe some hesitation to book travel to the U.S. Now, I don't want to overstate it, but airlines live on the margins, and Air Canada recently mentioned that overall industry, the bookings for transborder is down about 10% over kind of the April to September time period. So there's definitely an impact, maybe not as great as some of the headlines make it out to be, but there is kind of an impact from kind of inbound travel, and especially looking into even the summer. What I would say is since the pandemic, inbound travel has significantly underperformed trends versus pre-pandemic. So for U.S. airlines, I think the more important trend will be what happens to outbound demand, especially if the U.S. dollar weakens or if people are feeling a little less optimistic about travel.
Interesting. Savi, thank you. Savi Syth there of Raymond James on the airline business and on JetBlue as well. I've always described the Dow as a weather report for a town no one lives in anymore. The weather report's dreadful, and it's a weather report people follow. It's raining right now. I don't know how many vacations you'd be booking with anxiety about the economy as high as it is. Equity futures down 2.7 on the S&P. Up next, Michael Gapen of Morgan Stanley, Meghan Graper of Barclays from New York. This is Bloomberg. $60 minutes away from the opening bell. Equity futures recovering just a touch, well off the lows. We were down by 5% overnight. At the moment, we're down by 2 on the S&P. We are down by 2.8 on a Russell. On the Nasdaq, by 2.1. With 60 minutes until that cash open, let's get you an update on some of the morning movers this morning. Here's Danny Berger. Hey, Danny.
Hey, John. It is still the Mag 7, which is under immense amount of pressure. Nvidia down some 5%. Goldman Sachs saying that hedge funds had their biggest selling day on record since data going back to 2010. So it's no surprise some of these hedge fund darlings, like the big tech, like Nvidia, have continued to be in free fall. It's not just tech, though, that is under pressure. The banks have had a rough go over the past 2 trading days. That continues today. Goldman Sachs down 4.4%. There's a note out from Morgan Stanley this morning downgrading Goldman, saying that this is the wrong kind of volatility, is volatility that is bad for investment banking and management fees, which, by the way, we're seeing a lot of the big asset managers down as well on that very same narrative that fees when it comes to asset management are going to be under pressure. Finally, wrapping it up with a Reuters story over the weekend, Howmet Aerospace. This is a Pittsburgh company, and it supplies crucial parts to airlines. to different airplane manufacturers, rather, declaring a force majeure, meaning that they don't necessarily have to honor their contract because of the unforeseen event of tariffs. John, just underscores how supply chains might increasingly come under pressure as these tariffs kick in.
Danny, thank you. Appreciate it. Let's talk about that calendar. Those tariffs are kicking in over the weekend, a baseline 10%. Coming up later this week, just 2 days away, the reciprocal tariffs. So that's 20% on Europe, 34% on China. China set to retaliate a day later with their own 34% tariffs. And the same day we get US CPI. So lots of data, lots of tariffs, lots of Fed speak. Mike McKee has more. Hey, Mike.
Hey, John, we've got data coming up, but it's not till the end of the week, so it's going to be a while before the economy impinges on what people are thinking. But it is going to be interesting to see what we get out of CPI and on Friday, PPI. Right now, we're looking for a little bit of an increase in the producer price index on a year-over-year basis. Basically, base effects, but it is certainly possible that there might be some interim moves in CPI and PPI because of tariffs in terms of people stocking up ahead of time. What we saw, of course, were a lot of imports in December and January in particular. And we'd see tariffs start to hit first in fruits and vegetables, coffee, things that we don't make here and have to be bought on a short-term basis. A lot of toys came in, wine and beer, now that they're tariffing beer cans, the aluminum. And then we saw companies bringing in finished metals, industrial supplies, electronics, trying to get ahead of the tariffs. Some prices may have risen, but it's not going to tell us much about where we go from here. The thing that everybody's going to be watching, of course, is what's the Fed's reaction to everything going on in the markets. Not going to be a whole lot different from what Jay Powell said on Friday, but we do have a fair amount of Fed speak today, including a number of members of the Open Market Committee who are voters. Kugler, Barkin, Schmidt, Goolsbee, Bowman, and Musalliman Williams all speaking this week, and they all vote. We get the minutes on Wednesday. Is it going to tell us much? I don't think so, unless there's some sort of liquidity problem. But the Fed still has the discount window and the standing overnight repo facility in case people need liquidity. So they could provide that without making any monetary policy changes. And I just want to mention one more thing. The Fed Board of Governors is scheduled to meet today, a closed-door meeting to discuss discount rate minutes requests. This is a standard, regular kind of meeting. They have this in between the Fed meetings every time. And there is no indication that it would have anything to do with any kind of monetary policy changes immediately, and it doesn't include the rest of the Open Market Committee. So if you get some tinfoil hat social media, it's not something to worry about.
Mike, thanks for clearing that up. Taking down the temperature just a little bit. Michael McKee there on the week ahead and on that closed-door meeting, which was scheduled.
Thank you, Mike. I've actually gotten a number of messages already saying, oh, my
gosh,
excited.
Emergency
Is this
rate
it?
cuts.
They're going to end up coming out, staving off declines. Look, how much is this week's economic data going to matter at all? Will people look at it in the slightest? How much does any economic metric matter in any capacity at a time where policies are moving this quickly and this massively?
Things move quickly, and sometimes the Federal Reserve doesn't respond as fast. Do you remember the pandemic? Yes, they did a lot, eventually. But I remember one interview that Mike did with one Fed official. I'm not going to name them. And they sounded almost tone deaf in the face of what we were basically facing when the pandemic was shutting down cities across the world. So Chairman Powell went into the weekend saying, I'm not blinking. Essentially, that was the message from the Fed chair. That can change quickly, but you can hear that on repeat for quite a while before it does change. And then once it does, they move big and fast, as we've seen before.
Which is the reason why Andrew Hollenhorst over at Citi reiterated his call for 5 rate cuts just a minute ago through the remainder of this year. This time, though, feels a little bit different because there are dual threats of both inflation and a downside risk to growth. And you're coming off a pretty solid place when it comes to the economy. They're in a different place now than they were during the pandemic or in 2008.
I think also, Lisa, to build on that, I think they're scarred by the experience coming out of the pandemic.
100%.
21, 22, conditioned by the mistake they made then, and maybe they repeat a mistake this time, but a different kind of mistake.
So this is a reason why they are incentivized not to act rashly in response to this. If something breaks, all bets are off, and that's why people are watching the infrastructure of the system.
Joining us now is Michael Gapen of Morgan Stanley. Michael, welcome to the programme. Let's get straight to it. Let's frame it this way. Coming into 25, where did you have growth? Sitting here this morning, where do you have growth now?
So coming in 1.5%. We haven't made changes yet, but closer to zero from the direct effect of the tariffs that would go into effect last week.
So right now, going forward, Michael, how much are you actually pricing in all of what we've seen with respect to tariffs and using that for the new projection?
Yeah, I think so. The trick, Lisa, is, it's easy to pass through what we'll call the direct effect, meaning this is a tax on consumption. How would it weigh on consumption, trade, and in imports and exports? The harder thing to understand right now is the indirect effects. What does it do for business confidence? What does it do for investment, hiring? And then the more equity markets are down, the more you have to ask, what about wealth effects on upper income consumers? So in some ways, Lisa, it's a lot more about psychology now than it is mapping the direct effect of tariffs on spending and trade.
So let's go hear from our psychologist in chief, one of the many that we have, Fed Chair Jay Powell, who often comes in and soothes markets when they get a little bit jumpy. And we have seen this time, Jay Powell does not want to do that. He wants to revoke his therapy license and say, look, I'm dealing with inflation here. You actually removed the risk of the Fed cutting, or the chance of the Fed cutting rates in the initial aftermath of the tariff announcement. Do you feel differently now?
No, it's essentially a recession call versus an expansion call. If we don't get a recession, it's going to be hard for the Fed to look through this inflation in the short run, right? So, and Powell essentially admitted this. He's like, we're going to react to the deviation from our mandate, meaning is it inflation that's far from its target or the unemployment rate that's far from its target? So if you're not penciling in a recession, then I think it's right to take out Fed cuts this year. At least the Fed's going to be on hold for the foreseeable future. And I think what I would frame this is the tariffs almost guarantee the Fed's going to be late. So they will respond to weakness in activity only after it materializes. So you probably need negative payrolls now to get the Fed to act. It's going to be hard for them to act preemptively.
Mike, back in 2018, we saw high yield seize up. No issuance at all in December 2018. And that was a moment that unnerved the Federal Reserve. Are you suggesting that maybe even with that kind of stress in financial markets, because of the upside risk to prices, they might not be able to move?
Yes, and that's exactly right, because tariffs push up inflation now, they weaken activity later. So it guarantees the Fed's likely to be late. So if there's what I'll call a market dysfunction moment, yes, they will try and use some of their liquidity tools to maybe reduce stresses in markets. I don't think that's what you're getting at there. This is more like kind of front end market functioning, which they've addressed in the past. But in terms of the monetary policy easing and the monetary policy response to what's going on, yes, I think they actually need to see actual hard evidence that the economy is rolling over or we're getting job losses instead of job gains.
Mike, considering the size of the policy shift, I am surprised, I have to say, by the minimal downgrades that we've seen to growth and upgrades to inflation. I've heard numbers of let's say 4% on PCE. And some people are saying 0% growth. But at the same time, I'm seeing headlines that say the biggest policy shift we've seen in a century. 20% tariffs on Europe, 34% tariffs on China. 0% growth and 4% PCE is pretty tame with that in mind, isn't it?
So some of this, I think we have to make assessments of how long might these be in place, and is a 22% effective tariff rate going to come down? So yes, I think there's still a lot of moving parts to this. But John, what I would say is it's the direct effect versus the indirect effect. When you get into the psychological component, right? Recessions are about feedback loops. And here, I think the two main ones are business investment and hiring, and then that wealth effect on the upper income consumer. If you play that out and assume, bad responses from those sides of the economy, then you're easily into negative growth and a sharper rise in the unemployment rate. So I would say most people are baking in the direct effects of this and perhaps leaving those indirect effects for later.
Interesting. Thanks for clearing that up, Mike. Appreciate your time as always. Michael Gapen there of Morgan Stanley on the latest for the economy off the back of the huge policy change we've seen over the past week or so. Talked a lot about equities gapping lower. Talked a fair bit about this morning. This move in bond yields. Yields now higher on the session on a 10-year up by 3. On 30s up by 6 or 7 basis points. There is a long list of things that could be happening here. One of which is maybe people are avoiding dollar-denominated assets, even with risk assets cratering lower. That's one option. Another option is we're in a situation where you sell what you can and not what you want. That's another option. Lisa, the list is long, but the list is full of some pretty scary reasons for why treasuries aren't running this morning.
Yeah, I would agree with that. One not as negative interpretation of this is you are seeing equities off their lows of the session. You are seeing them retrace some of the losses from earlier, and you are seeing this bit of pushback. Kevin Hassett, the chief economic advisor to Donald Trump, speaking on another network in the United States and saying that more than 50 countries are negotiating on tariffs, that it is time to ease off the rhetoric a bit, and that there are some great deals countries are bringing on tariffs. So maybe giving a little bit of hope that it's a negotiating tactic. Again, hard to know what to make of any of this, but it's making the rounds this morning.
He said the same thing over the weekend, almost verbatim. Exactly the same thing.
I'm not saying that
Commerce
this is what you do.
Secretary Howard Lutnick came out and said the tariffs are going on.
I'm just saying.
President on Air Force One, take your medicine.
Okay, you're right. But right now, this is a market looking for reasons to hope.
Couldn't agree more.
And so how much is that feeding some of this? Yeah, I'm just trying to look at another option to throw in there.
We're still in this ridiculous situation we were in on Thursday, on Friday. We're still in it this Monday morning. New rules of the game or the start of negotiation. Depends on your market bias, but ultimately, the administration is telling you repeatedly they are the new rules of the game. I'd go one step further. The president has complicated negotiations even more by telling people this is not just about removing your tariffs, it's about giving us a plan to show how you'll get rid of the deficit. Help us get rid of the deficit and get rid of your surplus. You cannot do that overnight.
I'm going to bet you a pot of chamomile tea that in 2 weeks, we're going to be having the same debate and it's not going to be resolved.
I think we need more than a pot of chamomile tea, but I'll take that. Meghan Graper of Barclays writing this. Core inflation will likely rise markedly over the coming months as tariffs are implemented. Labour report needs to weaken materially for the Fed to cut as much as it currently priced in by the market. Meghan joins us now for more. Meghan, good morning. Good to see you.
Good morning. Great to see you.
What changed for Chairman Powell over the last week?
Oh, I mean, things have become much cloudier. I think it's a much more complicated hand that he's been dealt. And frankly, we've downgraded our growth forecast, I think, in good company across the street over the course of the last 48 hours. So calling for two periods of negative growth in the second half of this year. We're calling for unemployment to tick back up to 4.6 by year end. But the bigger problem for the Fed is that we're calling for an increase in inflation. So it's up, 4% on the core CPI number by year end, 3.7 on core PCE. But to your point earlier, it's not really about where inflation is today. I think for Powell, he's looking out where is inflation a year from now or 2 years from now, and looking at his legacy as a piece of that.
You're running debt capital markets. How well supplied has this market been in the lead up to this? And what kind of issuance are you expecting in the next few months now?
Yeah, this isn't a liquidity event, and I think that's the net positive. So if we look at investment grade markets as really becoming a safe harbor for issuers and investors, we started out the year with a record amount of supply. An all-time record. Why is that? It's front-loading. It's not a nominal increase in funding needs, but it was a defensive posturing, I think, heading into expectations that this year would be choppy to navigate. And so, think about, the issuers we're talking to. I was on the road the last week talking to CFOs and treasurers. They're very defensively positioned heading into this, which net is a positive. They have extended their maturity profiles. You're watching EBITDA margins that are upwards of 30% still. I mean, it's far above 2004 highs. At the end of the day, they're appealing to investors who are flush with liquidity. So you talk to the buy side, the silver lining, the bright spot in the noise we saw in the last 48 hours is that investors continue to have cash to spend. Why? There's $400 billion of coupon income coming back into investors' hands this year. They've got record COVID debt maturing. That's all cash coming back into investors' pockets. And so we saw actually net buying over the course of Friday's session, as bad as it felt in other places, $2.5 billion of net buying. It's pretty astonishing.
Well, we've also seen deals pulled. Companies have been planning to issue certain deals and have decided maybe they ought to wait till another time because this might not be the best week in the world. Does that concern you, or is this just a timing for the best price kind of issue? And if they needed to and wanted to, they probably could, just at a small haircut to what they would like.
Yeah, I mean, in investment grade, we haven't had deals pulled, but they've been postponed. So we're evaluating entry points. And it's really three camps, I think, emerging as I talk to issuers. The first are yield-centric investors. And so you look at these moves in underlying treasury yields, it's more than offset the spread widening we've seen in investment grade. So net, in mid-January, you had, 478 on the 10-year note. 4% or sub 4% feels like a reasonably good entry point, even if you need to pay higher new issue concessions to appeal to some of that liquidity. Then you've got spread-focused borrowers. I think there it's a bit more defensive, shelter in place, if you will. But in talking to what are largely bank buyers in that subset of issuers, many of them are already 40 to 60% through their funding needs for the year. So there's no real urgency here. We're not seeing any signs of panic. And then there are others that are just flush with cash, and I think maybe disappointed that business investment is slowing. But all in all, I think well-positioned and willing to ride out the storm.
There's a larger question here. You said that there's plenty of cash and the investor base is looking for good investments. A lot of the investor base used to be overseas, Japan in particular. And there's a real question, and John was alluding to it earlier, will some international buyers withdraw their interest from U.S. markets on the heels of a whole host of different policies as well as currency differentials? Are you seeing any signs of that?
It's a great point, and I think it's something we need to continue to closely monitor. So retaliation may not be just as it relates to tariffs. It may actually be as it relates to investment in U.S. assets. And the largest growth of underpinning to demand in investment-grade credit has come from overseas investors. It's 20 to 25% of the market, so not insubstantial. On the new issue side, it's probably 15% of the order books that we're seeing. About 40% of that is Europe. About 25% of that is Asia, and then you've got 10% or so from Canada. The mitigants to that money moving away from investment-grade credit are really two or threefold. One is they already own 20 to 25%. So are you really working against your own book by paring back or not showing up to the new issues that emerge here? On the other hand, it's one of the few places you can source duration. And it's also the most liquid market around the globe. So $8.5 trillion of assets. It would be difficult, I think, to move back to their home markets. We did see one or two instances of smaller size real money pension investors on principle stepping back from the market last week. But it was a small fraction, and net 6.5 of net buying over the course of the week says it was a drop in the bucket in terms of those who pared back. But certainly something we need to keep an eye on.
It raises the question, where else do you go? Mike Gapen, who was just pinged me on the Bloomberg terminal, said trade's only a fraction of US GDP compared to other countries. The larger revisions may come outside the US, and it may be more of a global recession story than a US one. That's something we have to think about. I think over the last 2 months or so, we just talked about trade, looked at the market move. The market was basically the bias for everyone to frame their own view on what was happening at the moment. Equities were underperforming in America, outperforming in Europe. Everyone talked about the pain in the United States. Over the past week or so, we've only just started to talk about the pain abroad. In Europe, stocks down hard, Japan, in China. That's a new phase of the story.
This was what people thought would happen late last year when they were looking at a potential tariff regime. The U.S. sneezes and the rest of the world catches a cold. That was upended, partly because people, A, didn't believe that these tariffs would go on, and B, were so excited about the idea that Germany was going to spend money that it seemed like the whole world could be a brighter place with fiscal stimulus on some level. There is this issue of whether this is the right sizing and the unwind of some of that capital shift that we saw earlier this year.
Meghan, this was a clinic. It's great to catch up with you. Thanks for your time. Thank you very much. Meghan Graper there of Barclays. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. JP Morgan Chase CEO Jamie Dimon is urging a quick resolution to tariff policy issues. In his annual shareholder letter, Dimon wrote, "The quicker this issue is resolved, the better. Some of the negative effects increase cumulatively over time and would be hard to reverse." Dimon predicted an increase in inflation for both imported and domestic goods. The AP this morning reporting that Ukraine will send a team to Washington to begin negotiations on a new mineral deal. Both sides were expected to sign a deal in February, but that was derailed after the contentious meeting between President Zelensky and Trump at the White House. Ceasefire talks between the U.S. and Russia are also expected this week. Oil prices falling for a third straight day, down nearly 2% after Saudi Arabia slashed its flagship crude price with an escalating trade war. Goldman Sachs has also reduced its forecast for the second time in less than a week. They now see Brent at $62 to end the year, down $4 from their prior view. And that's your brief, John.
Danny, thank you. Appreciate your time this morning. As always, up next on the programme, we'll set you up for the week ahead. We'll get a final word from Annmarie down in the nation's capital. Live from New York, this is Bloomberg. Live from New York City, equity futures down 2% on the S&P. On the Nasdaq, we're down by 2.1. Here we are, the Monday after the Wednesday, when we had this announcement from the President of the United States, and yet still this debate continues. Is this a negotiation or the rules of the game? The EU Commission President, Ursula von der Leyen, coming out this morning and saying that we will negotiate with the US on tariffs, but also saying that we'll focus on 83% of the trade not with the United States. She has talked about negotiating before. She has said if it fails, she will retaliate. We're just 2 days away from reciprocal tariffs.
This is a market in search of a narrative and in search of hope, given the fact that this market is really contingent on the idea that there is going to be some modicum of the old trade regime. And if it is truly upended, it has to be completely rethought in terms of price targets and in terms of returns going forward.
Equity futures recovering just a touch, bond yields higher as we count you down to the opening bell. Here's the trading time for the week ahead. At 2:30, President Trump holding a news conference with the Israeli Prime Minister. On Wednesday, reciprocal tariffs kick in. We get earnings from Delta 2. On Thursday, an inflation report plus jobless claims. Friday, PPI and UMich sentiment plus bank earnings. JP Morgan, Wells Fargo, Morgan Stanley. Let's give a final word from DC with Annmarie. AMH, negotiation or rules of the game? There's something to cling to every single morning. And once again this morning, negotiation or rules of the game? Which one is it?
Well, I think the administration is still trying to figure that out. I looked at what Kellyanne Shaw said, who worked under Trump 1.0 as a trade negotiator. She talked about how maybe it's a little bit of both. And if you want to be negotiating, you have to be uncertain and you have to be ambiguous. I take to what Kevin Hassett told reporters this morning, talking about the fact that he says the president right now is going to decide what the president wants to do. There are more than 50 countries in negotiation with the president. I guess one of them will be today. We'll hear what comes out of this meeting with the Israeli prime minister. Kevin Hassett goes on to say that they got a call from Taiwan. And then he has a message for Bill Ackman, Jonathan. He says it's time to ease off the rhetoric a little bit.
AMH, appreciate the feedback. Thank you. Attempted to turn down the volume, apparently.
Good luck. The way to do that is to come out with a deal. Let's see if that happens.
Up next on the programme, tomorrow morning, we'll catch up with Peter Oppenheimer of Goldman Sachs, John Lieber of Eurasia, Julian Emanuel of Evercore, and Mira Pandit of JP Morgan from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.